Good morning, everybody. Good morning, good morning. Nice to see you guys today. Um, yeah, Paul, it's pretty amazing how your software comes to be. I like sharing that picture though, because it reminds everybody that it's areas. These fibs are areas, right? These are just accumulations from a calculator that came together to do it based on my brother's genius. Good morning, Morgan. And then you have more exact ones. You have yellow one-to-ones, you have divergences, and these are precise numbers. So we can talk about that a little bit today if you guys want to. Um, Hope everybody had a great weekend. Did something fun, met somebody, I don't know. Whatever it is that you like to do on your weekends, I hope it went well for you. Mine was great. I'm excited to uh, to be back working it. Got some new faces in here, right? John 20, nice to see you. Jonathan and Chris, good to see you. Jonathan Christopher, good to see you back. Who else is in here? Joe PM, I recognize the name. Hey, Miss Jen, Mr. Muser. I'm assuming it's Mr. Muser. I don't know. Some of you guys, I don't know what your gender is. That's okay. Okay. I don't want to cross that line, guys. It's going to be an outstanding week. Hey, can I ask a favor of everybody in the room, if you don't mind? Um, John Novak has bought the greatest toy in the world. Good morning, Andy. And it's this AI bot that is going to help, hey, Malcolm, get questions answered when we're not around. Questions like, hey, what is a 50-50 trade? Or what is divergence? Hey, Miraboy, good to see you. Um, Guys, if you have questions, type them in the room as simple as you can. If there were questions that you've had as a new trader, type them in the room as simple as you can. Um, or maybe later after class so we don't go through answering all the questions over and over again. But that's stuff we're working on. A lot of really cool stuff coming on. Yeah, or do it in the trader room. That's even better. A lot of really great stuff coming up with Nexgen and the new Nexgen funding, all that sort of stuff. I was told this morning that you guys are going to have to look at my ugly mug tomorrow during class. We're going to put a face to the name, apparently. But before we do anything, ladies and gentlemen, hey, Chef. Man, I got all the folks coming back. Um, Rob, good morning. Guys, let's go check news. I'm not sure what's going on, but every FOMC member that I've ever heard of is talking today. I don't know if there are a bunch of meetings going on. I do know that there was some 9 a.m. news right now that's medium impact that may create a little jump and a bump. Um, no worries, Jonathan. We'll talk about it after the first hour, and we'll go through annotating a little bit too. I do like that you're posting the pictures in there, so we'll go back and talk about it. Um, and we'll talk about the rules, and then when we do, I'll annotate your chart with capture so that you can have a little heads up on how to do that. But guys, I check news every morning. I like to look at it, see what's going on, make sure that I'm not jumping in front of a freight train of emotion. I don't trade the news. That's the one thing that I really want to stress about news is I don't care what FOMC member Barr says. It makes no difference to me or my trading or anything that I'm doing. What it does is it lets me know that there may be people that do care. There may be people that want to have a reaction to whatever the statement is. And when I see medium and high impact, I just choose to stay out of the market. That typically works out the best for me. So every morning I do that, and everything that I talk about, I say it over and over, comes right from the education page, guys, right from the Nexgen software services. Hey, Erla, website, and there's the education tab. And there's two tabs, guys. There's a software guide. You don't need join Discord. You're already here. There's a software guide. This is your NinjaTrader how-to. Good morning, Cav. I encourage everybody, if you have a question about NinjaTrader, if you're wondering about stops, targets, scaling, opening, closing, making new charts, adding templates, whatever, raise your hand in the room. Let's get you taken care of. But if you are sitting at home, it's 3 in the morning, you can't sleep, and you're like, man, I'm going to go build some charts, This is kind of your how-to right off of the website. It's the software user guide that's going to get you where you want to be. And then everything that I talk about each and every day, right from the trading guide. Um, Guys, I am such a sucker for simplicity. I'm not going to lie. I try to keep it as basic as I can, as focused as I can. I try not to overcomplicate things. I try not to give you this myriad of concepts that you've got to memorize. We're going to keep it super simple, guys, and we're going to talk about a high probability trend trade. That's going to be the first thing, first hour, every day, high probability trend trade. Because it teaches you to be a chart reader, guys. It teaches you to read your indicators, and that's the most important thing that you can do, is to be able to look at your charts and understand a couple really key concepts, like where the market's likely to continue. We're going to talk extensively about how you can pinpoint with amazing accuracy where the market is most likely to continue, and to use that spot as an entry for the high probability trend trade that we teach in this first hour. Eventually, you're going to understand where the market is likely to go, and the better you get at that, the more precise your exits are going to be. And then finally, you're going to understand where the market is likely to stop. I love the likely to stop places, guys, and I think that this is such a great lesson because not only does it keep you from trading into areas that may stop the market, but what it also does is when one of these likely to stop areas, we call them termination conditions, when it reverses the market, man, it is like the most powerful platform looking for trades the other direction, and you're going to be able to come up with a plan that helps you capitalize on that. So learn to read your charts, guys. It's about 90% of everything you do every day. 90%. I'm going to tell you right now. What is it? It's 9:06 a.m. I was up at about, oh, I don't know, 6:30 a.m. Eastern this morning. And I sat and I watched the market, and I sat and I watched the market, and I did absolutely nothing until about 4 minutes before class. And then I finally caught a short, and I made some money, and I'm coming into the classroom with good mojo. So it's okay to do nothing. Not every move is your move. Not every penny is your penny. So develop a little patience. Really insist on things being perfect, giving yourself a statistical advantage each and every time you take a trade. And we're going to do that by talking about the high probability trend trade. Because a high probability trend trade is a trade where each indicator on every chart agrees for the trade, guys. And I'm going to tell you, this is the best of the best. This is the easiest. This is your foundation. And when I say it's your foundation, I mean, if you can get to the point where this trade is easy to recognize, where this high probability trend trade, where all the triggers are the strongest, where there's no termination conditions, where there's no trouble spots between you and your target. If you can take this trade and you can take it consistently, it's going to turn you into a chart reader, guys. And when you're a chart reader, that's what opens doors. That's what lets you see these next level trades, these momentum trades, these HVA trades, some of you even edge trades. Heck, I've got people in the room that take counter trend trades because of their ability to read charts. So we're going to focus on the high probability trend trade. It's only 3 rules. That's all it'll ever be. No matter how much you try to will extra rules into it, it's only 3 rules. And a trade is an accumulation of the 3 rules that are produced, or the 3 advantages that are produced by the 3 rules. A trade is momentum. It's a clear path and it's an entry area. And we're going to couple these together. It's the first 2 that I really want you to make sure that you're comfortable with, because when you're comfortable with momentum, there's an awful lot more opportunities where you can take advantage of that momentum. And when you're comfortable with a clear path, what it does is it creates patience. It keeps you sitting on your hands for just a little bit longer, waiting for the best opportunity. And then entry areas are going to change over and over. But for the brand new user, entry areas are just going to be where the market's likely to bounce to go with that momentum, to go with that clear path. So 3 rules for the high probability trend trade, and these 3 rules will come to fruition on only 2 charts. There is a large chart and a small chart. How easy is that? Pretty technical, right? Large chart. Guys, the large chart's going to take the most current bar. You know it's the most current bar because price is highlighted in black. And on this bar right here, That large chart is going to define the direction of the market. If the background is green, it's going up. Your highest chance of success comes from finding that high probability trend trade rules met long, buying the market, going with the flow. If the background is red, the market's going down, and the same is true. The easiest, the path of least resistance, is simply following that large chart, going with the direction. It is going to define the momentum of the market. That's rule number one. And rule number one is going to let you know if that momentum is present, if you have an opportunity. And rule number two is going to make sure that that path is clear. It's by defining the areas. All of this, direction, momentum, and areas, comes from the first bar. Once your first two rules are met, and remember there's only three, we're going to go to a smaller, faster chart, a refinement chart. And this is where rule number three is going to put you guys in the market, where the market is most likely to continue. By doing so, by taking this smaller, faster chart, it's going to refine the broad stroke of the brush. It's going to take that one bar, dissect it into about 30 bars, and you are going to pinpoint with awesome accuracy where it's most likely to continue. This is going to allow you to reduce risk. You're going to increase profit potential. So let's keep it easy, guys. 3 rules, 2 charts. And the reason we use 2 charts, I like to share this picture, is because there's really 2 forces in the market. And you're neither of them. Just a heads up. You are not the large crowd or the small crowd. You are a little barnacle on the bottom of the boat of life, headed towards wherever that boat is going. So it's easier just to go with it. Your large crowd, guys, they are going to define the areas, create the momentum, establish the trends. These are the guys that we want to be friends with. And then the small crowd, your small chart, these guys fight. They give little pushes. We love those pushes because we're going to take advantage of those. And what we'll be able to do is we'll be able to pinpoint right where their push is about to peter out. And that becomes your entry for the highest probability trend trade. We're going to go through the whole Monday thing, guys. Your step-by-step path to becoming a confident trader ASAP. That's what we all want, right? I bought software. I'm leasing software. I'm doing a demo on software. I want to make $1 million next week. Guys, be realistic. Med students are not performing heart surgery in their first year. Good morning, Zorro. But there is a path to get to where you want to be sooner than later. And it begins with posting your trades in class. Posting everything you see, talking about everything you see, everything that's going on. And I'm going to show you how to do that real quick. So guys, we're going to do a capture software lesson real fast. So Jonathan, this is for you. Capture software was downloaded on your computer when you download the software. Just for grins, guys, I'm going to give you a link to it. If you can't find it on your computer, that's okay. Go download it real quick. It'll take you 2 minutes. This capture software, it's nothing more than a tool to take pictures. So if I click on the big red button that says capture, it's going to give me the option to take a picture. If I don't do anything and I just leave it resting over one chart, it's only going to give me one chart's worth of information. But we've already established we're 2 chart traders. So you need to go to the upper left-hand corner, left click your mouse and drag it all the way down to the bottom right. Once you do that, guys, what's important for me, just from an education standpoint, is that you show me the timestamps down at the bottom, that you show me the prices and the vertical axis, because we're going to line these up between large and small to see how we did. Once I release the mouse, it's going to ask me, hey, Mark, do you want to take a picture? Did you want to take a video? Maybe while you're trading, take a video, talk yourself through it. See just how frantic you sound when you're moving those stops. I've done that one. In the beginning, it was kind of funny. Now it's pretty calm and mellow. So I'm going to capture an image. When I capture the image, up comes my capture image preview. This is half of it. And guys, I'm going to ask you respectfully, do these next steps for me. This is an educational room. I am really good at reading charts. Almost is good enough to teach a class on it. But the thing is I don't know what you guys are doing. I don't know what your reads are. So what I need you to do, and I'm going to show you the picture real quick, and I'm just going to share it with you. In order to annotate your charts, guys, the whole reason you guys post in the room, I hope, is to get feedback about everything you do so that you can make sure that you're reading the charts right, so that you can pinpoint your entries, get into the right spot, get out at the right spot, mitigate risk, all these things you're supposed to do. So I need you to tell me what you saw in your charts. I need you to say, hey, Mark, the trend was down, the momentum was strong, the path was clear, and I waited for a pullback. And I entered it right at an area inside of favorable large triggers. And then I got scared and jumped out at a blue line. Or I held it all the way to Fibonacci support. And if you go through the process of telling me what you see every trade, one, it keeps me from guessing, right? It keeps me from going, I think, Erla, you were saying that everything was red and these tails represent an opportunity. But Erla, I don't understand why you jumped in here and then you held a momentum trade all the way through the loss of momentum. And Erla's like, but Mark, isn't it obvious? There was odds favorable momentum over here. And I'm like, Erla, nothing's obvious to me. Tell me what you're doing. Tell me why you held. Tell me what made you believe you were going to get down to that fib. And it's not for me, guys. I can see exactly what Erla's thinking because I've been doing this for a while. But the key is, if Erla is a brand new user, and Erla, thank you for letting me use you as an example here. My goal for Erla is that Erla can do the same thing that is bringing success, that Erla recognizes why the entry was taken, why the large chart said go, why the exit was taken where the exit was taken. And then, guys, it's that process that allows you to do the same thing every day, to follow your rules to the letter, to have a statistical advantage each and every time you pull the trigger. Hey, JW. So you've got to write what you're doing in each of these tools up here. So Jonathan, here's yours. There's an arrow, there's a call out button, and there's a shape. And these are the three that we're going to use, guys. So each of these is a click and drag tool. So if I click on shape, it's my active tool. If I left click and then drag down to the right, I'm going to make a box. And that box is going to keep growing until I release the mouse. So I can make a little box, I can make a big box, I can make virtually no box. Maybe I make a box around what I want to talk about. Maybe I make a box around areas that I'm hoping to get to. But the idea is that I'm using this visually. Mark, this is what I saw. Same thing with an arrow. This is what I'm looking at, Mark. These are the things that I want to talk about. And then using this call out button, click and drag. It's going to let you make a text box. And here you might say, this is weak triggers. Just getting a lesson. And here you might say, this is a tail or a wick. Was there an entry? And down here you might say, is this fib a target or a term, right? Or if you entered right here, well then you may say, this is what I saw. This is why. And what you say every time you tell me this is why, what you're doing is you're asking, am I reading my charts correctly? And guys, I'm not going to say, hey, you broke a rule, shame on you. I'm going to say you broke a rule. So let's look at advantages, let's look at disadvantages. And I need you to make a decision on whether or not you really want to risk your money into this fib with the gap theory, with no triggers through it. And what we'll do is we'll work hand in hand every day to get where you want to be. Once you have all of this on the chart, I'm going to put copy. Notice that it can be a question or it can be a read, guys. Either one, both of them get you feedback in the room. I'm going to click copy down here, and by clicking copy, what it does is it lets me come over, drop it in the room. Second hour, third hour, 100%, guys, focused on feedback for you. But the second half of what is going to get you where you want to be is using a spreadsheet, using the spreadsheet that Nexgen gave you. So in order to use that spreadsheet, the easiest way to do it is to click the upload button. And this upload button is going to put your picture into the cloud. It's going to give you app.screencast. And now there is a link to take that to somebody's server so that you can always retrieve it. If you copy that link, you can drop the link in the room if you want. I don't care if you copy paste the picture or the link. Either one works. But what you can do is you can come back to the spreadsheet, guys. Nexgen gave you the spreadsheet. I give you mine every day. I'll give it to you again right now. There's 4 tabs on the spreadsheet. The first tab is your trade journal. And every time you take a trade, drop it into your trade journal. And what you're going to do is you're going to come back each and every morning and you're going to say to yourself, what worked? What didn't work? What felt forced? What felt easy? And you're going to do this little historical study every morning and you're going to set yourself up for success for the day. Maybe yesterday you traded into those likely to stop areas a lot and you didn't find the success that you were hoping to do. If you study the trades, and again, if you read the annotations on the chart, and most importantly, if you take the feedback from class, what you're going to do is you're going to wake up and you're going to say, you know what, yesterday, those darn termination conditions were robbing money from me. But what I noticed is that when I had momentum and a clear path, things seemed easy and I was able to take profits. So what you've done is you've defined your focus for the day. One of the worst things that I think new users can do is take losers and not know why, is to make mistakes and not know mistakes are being made. Using the spreadsheet is going to help you eliminate those mistakes over and over because you're going to see them. In that little study, you're going to recognize patterns that are bringing you success. You're going to recognize patterns that are taking your success, not only in the market, but also in yourself. And guys, one of the most annoying things about me, I'm going to just go ahead and share it right now, is that I don't forget things. It's a pain in the butt. Ask my wife. But if you post 10 charts in the room, guys, and you do the same thing 5 times, I'm going to tell you, hey, Jen, this is your thing. This is what I keep noticing you doing, trading into these areas, hoping that they break rather than just waiting for them to break. Maybe you could increase your profits and decrease your losses by simply embracing termination conditions a little bit. And Jen's going to be like, oh my gosh, I didn't even notice that. And if you change Jen's name with my name and my name with John Novak's name, that's exactly how I fixed a lot of problems with my trading. So use that spreadsheet, guys. We're going to learn the rules for when it's okay to trade. We're going to talk about the high probability trend trade. We're going to break it down into looks, and we're going to speak to ourselves in terms of advantages. You guys can simulate, practice, post in the room until you're sure you have the correct rules. If you keep it focused on following a very simple plan, it won't take you long to learn your rules. If you are hell-bent on finding all of the money instead of your money, it may slow down a little bit. Simplicity gets you to where you want to be, guys, and that's why we're going to simplify to 2 trades for the brand new user. I'm going to hand you in your hand a plan that is designed to optimize your chances of success each and every time you pull the trigger. You have to know what looks you're going to commit to. Take a lot of pictures. That you have to get them so that they become easy. And that's where the spreadsheet comes in even more, guys. There's a 101 tab that I put together, and I'm going to give you a little study guide on how to get the absolute most out of learning to read charts and how to get to where you want to be the absolute fastest. There's also the client trades, guys, with over 300 pictures of next-gen users being brilliant with the software. There is high probability trend trade entry sequences for both longs and shorts. There's a very mechanical management plan for beginners. There's a lot of patterns that repeat themselves, a lot of termination conditions. There's even stuff on the NASDAQ if you're a little bit of an adrenaline junkie. Guys, all of this is going to help you make it easy. The more times you see something when a market isn't moving, the easier it is to catch it when it is. And that's where the final tab that I'm sharing with you comes into play. This is your favorite looks tab. If you're studying rules and you see a picture or you take a picture and you're like, man, this is perfect. This is a statistical advantage. This is a pattern that wins more than it loses, no matter what kind of trade it is. You're going to build your personal plan. You're going to start taking these pictures, committing them to memory. You're going to have to learn how to manage those trades. So you're going to start taking a lot of pictures of management. You're going to see patterns all the time that repeat themselves. Start taking pictures, commit them to memory, and you're also going to see termination conditions, those likely to stop areas. So all of this comes together. Your section should look like my section, and I'm telling you, if you do the work to make it look like this, you're going to be floored at how well you can focus on advantages in the market. So Guys, excuse me just one second. I'll be right back, and then we're going to get into the high probability trend trade. Give me just one second, please. Go, baby. Hey guys, I'm going to leave her out here so that because she's going to go nuts if she hears you out here. You guys are fine. Baby, will you bring your cookie to the table, please? Thank you, my love. Did you guys sleep okay? Sorry about that, guys. I'm back. We have the very last of the house guests in the house, so they're playing with the dog, and the dog's coming to play with me, and I love it. So let's talk about high probability trend trades, ladies and gentlemen. Let's talk about the trade that teaches you to become a chart reader. We're going to spend about 35 minutes on it. We're going to focus on breaking it down into rules. We're going to talk about the advantages that are associated with each rule. And what this is going to do for you is this is going to give you the opportunity and the ability to look at your chart and always say to yourself, I have the advantage of momentum. I do, in fact, have a clear path. Let me look for my entry area. And if you speak to yourself in terms of advantages, this pays dividends a couple different ways. One, it lets you know when the rules are met. You're going to read charts, but your read is just a vehicle to get you to your rules. Your read is not your trades. Your read is saying, hey, I see the advantage of momentum, therefore rule number one is met. So if you always talk in terms of advantages, you're going to understand when it's time to look for that trade. And the other half of that is if you're looking at your charts and you don't see the advantage of maybe a clear path, well, then you know what you're up against. You know that there's a problem. And it doesn't mean that there's not a trade, but it means that you're going to manage it a little more aggressively. So if you say to yourself, man, I have momentum, I have a clear path, but I don't have the best entry area. I know that I'm up against having not the best entry area. Let me still look for an opportunity. Let me wait for a little confirmation. Let me protect my assets with tighter risk and quicker profits, but it still opens the door for trades for you. So we're going to start with the first advantage, momentum. Strong triggers on the large chart. Strong triggers on the large chart are pretty easy, guys. If the background is green, the market's going up. And if the market's going up, we're looking for rules to be met for high probability trend trades long. And the only way that I can have strong trigger lines is if the color of my triggers matches the color of my charts. So small triggers, these solid lines, and the large triggers, these dashed lines, if the background is green, they should be green in order to be strong. The smalls break above the large, create space between the two. Guys, right here, this gap lets me know that I have strong triggers. Strong triggers lets me know that the odds are favorable for the market to continue up. And when I talk about odds favorable momentum, that's exactly what I'm talking about. You're going to hear it in the room all the time, guys. Strong triggers up gives me odds favorable momentum. Strong triggers down gives me odds favorable momentum. And odds favorable momentum pushes that market in the direction of the trend. Odds favorable momentum has the potential to break key Fibonacci areas, to get us past those likely to stop areas. And odds favorable momentum in all its glory will cover up an awful lot of mistakes that new users make. It's hard to stop momentum, but it does slow. It typically slows rather than stops, guys. And as these small triggers begin to return to the large, as they work their way back inside, and when they finally get gobbled up by the large, this is a weakening or a slowing of the trend. And the phrase that we're going to use to go with this look, with these weakened triggers, is anything can happen up or down. The market may go up, the market may go down, the market may bounce, there may be a deeper retracement. Fibonacci areas are more likely to hold when they're arrived at with weak triggers. So odds favorable momentum is the absolute best of the best for short trades, and the slower it gets, the more aggressive you'll need to be with your management. But when you have odds favorable up, when you have odds favorable down, it's the best of the best time to use that refinement chart to either buy Fibonacci support to go with the long trend or to sell Fibonacci resistance on that smaller, faster chart. On the large chart, it looks like a wick or it looks like a tail. You will be able to pinpoint exactly where this tail is most likely to form, you will be able to pinpoint and not hesitate to enter the market with that momentum using the smaller, faster chart. So let's go to a large chart. Let me open one up here. Let me make sure that I've got everything open. I'm going to open up crude oil real quick, and I'm going to make that nice and big. And does everybody see separation between the smalls and the large? Everything says down. The triggers are strong. There's one of those tails, one of those potential wicks. It hits an area and bounces, and now at the most current bar, I have odds favorable momentum up. Does everybody see it? Can you give me a Y? Whoops. Smalls above the large are wide, they're angled in the direction of the trend. Ladies and gentlemen, if you learn to embrace this look, this is the one that carries you off to the promised land. This is the one that pushes the market in the direction. And you're going to see it all day long. You're going to see strong triggers up and strong triggers down. Odds favorable. There's another one of those tails. And look how the market just continues in the direction. When there's disagreement in the colors of the triggers, when the smalls are below the large rather than above the large, when the triggers are green and the background is red, guys, you don't have momentum. This is a transition period. There's no reason to ever guess. Simply wait for the best of the best. Wait for that momentum, and you'll see these tails all day long, guys. You're going to be pinpointing exactly where these tails are most likely to form. So, rule number one, odds favorable momentum. It's not Miraboy. It's not the wick that gives the opportunity for entry. The wick has already happened. The wick is a byproduct. And when we talk about entries, I'm going to show you using that smaller, faster chart how you can pinpoint exactly where the wick is most likely to form. But what you can do is you can scroll back and circle these wicks, and then by taking those wicks and going back on a smaller, faster chart, let's scroll back, you can see where that circle lines up, and you can begin to recognize opportunities in the market, and you can say, man, with this wick, with this look, that market on a smaller, faster chart pulled directly back to resistance right inside of favorable large triggers, and this becomes my opportunity to ride that wave of momentum all the way down to Fibonacci support. So there's a correlation between the two, and we're going to use the wicks when the market is on its way down. Where's that other chart? We're going to use these wicks when the market's on its way down to help pinpoint where the market is most likely to continue. Does that make sense? So as a brand new user, I can scroll back and just keep circling these tails when my rules are met. And that is a part of the equation, but it'll be the backtracking on my smaller, faster chart that lets me know whether or not the rules were completely met to take advantage of that momentum, of that path, to get down to finding profits. So great question. Thank you for that. The wicks are a byproduct, and I'm going to give you exactly what that means. But let's do it real quick so there's no confusion. If I put a box around the most current bar, look at how many bars are on that smaller, faster chart. That's that refinement process. So even though this bar doesn't have a wick, no even beginning to look like a wick, there's a pullback happening here. And if it pulls up and pulls back down, that's what creates those wicks. But we're getting ahead of ourselves a little bit, which I like. Strong triggers leads the way. Strong triggers creates opportunities. But once you have strong triggers, you have to go to the next advantage. Awesome, Miraboy. And the next one is making sure that you're not trading into those termination conditions, that you're not putting yourself trading into areas that may stop the market. Sorry, I just spun my chair and undid my headphones. Termination conditions, guys. Termination conditions false. When there's nothing that may stop the market in the way, I have room to my profit targets. We're just going to simplify even more. We're going to call this a clear path. So we're going to couple the clear path with the advantage of momentum, and we're going to do that by recognizing areas on the large chart. Just lines on the large chart. That's the easiest way to think about it. Lines on a large chart. If you try to make one line stronger than another line, you're just going to outthink yourself. If you try to make a dot more important than a dash, if you try to make a dash more important than a solid line, you're really just putting too much on there, guys. It's just lines. Divergence highs, divergence lows, red Fibonacci resistance, blue Fibonacci support, and these yellow one-to-ones. And we're going to use these lines because they can cause trouble. These lines are where the people that move the market, the people that are in charge of the market, this is where they're making decisions, guys. This is where the large crowd enters and exits. This is where the opposing forces, large crowds, the buyers and sellers, this is where they have the potential to fight. And what happens is we're going to use those T3 trigger lines, the same ones that give us momentum. They're going to let us know if these areas are likely to stop the market, if these areas have the potential to break, or if they've broken and they're in our rear view mirrors. And they're going to do it with a simple recipe. Price reaches the area. That's the first thing that has to happen. Price has to reach the area. Why? Because that's where decisions are made, right? You don't start ordering your cheeseburger if you're 5 cars back in the drive-thru. You got to get there, make that decision. And when you reach the area, all you have to do is ask yourself, in this case, it's Fibonacci support. So I'm going to open up some pictures of those too. If price reaches Fibonacci support and the trigger lines remain above, this is an area that may stop the market. That's it. It may stop the market. It might create a bounce. It might even reverse it. Hell, I don't know. I want you guys to embrace that little three-word phrase. I don't know. I don't know if the sellers are going to push through. I don't know if the buyers are going to take over. The only thing that you can be sure of as a brand new user is that if price reaches the area, the triggers remain above support, below resistance, you don't have a clear path. And if you don't have a clear path, well then any trade you take forfeits that advantage. So I want to give you guys a couple pictures. This is termination conditions at a low, reaching those areas of support. Price reaches yellow one-to-ones. All the triggers remain above, and all this means to Nexgen users is, hey, no shorts into the area. This area may stop the market. It may create a bounce. Price reaches Fibonacci support, even with odds favorable momentum. And the triggers remain above, and there's no more short trades to be had. And once again, rule number 2 keeps you out of problems. It keeps you from trading into areas that may create this reaction. The recipe for it's pretty easy. And then down here, price creates a pivot, and we get one of those divergence lows. Divergence is a fancy way of saying, hey, there was a loss of momentum in the market. That's it. Price comes down, price goes up, right about the 3rd bar. If there's a loss of momentum, you're going to see this light blue line. This light blue line coming off of that pivot is not a termination condition because we embrace the simple. And in order to have a termination condition, price has to come back and reach that light blue line. When it does, you ask yourself, where are my triggers? And if your answer is my triggers are above that light blue line, well then you're at a termination condition. You're at an area that may reverse the market. No more short trades. Look at the bounce. If price extends beyond that blue line a little bit and then goes back up, we're going to call it a pivot stop out. And pivot stop outs are powerful. More powerful still if they coincide with Fibonacci support and resistance. So there's your termination conditions at lows, guys, which means that there have to be termination conditions at highs. Here's one of those pivots, not a loss of momentum, nothing more than, or not a termination, just a loss of momentum. See how it extends that line off to the right. When price comes back and reaches that divergence high, it's a termination condition if the triggers remain below. It's a pivot stop out if price gets above and below. And now it's a termination condition. Here it's just a little, hey, look, they created a line in the sand. Here it may stop the market. Odds favorable into resistance may stop the market if the triggers remain below. You see it on the one-to-ones as well. So guys, I'm going to share these in the room for you. I'm going to try and give you guys a lot of stuff to drop into your spreadsheet today. Is everybody cool with it, with a very basic concept? If price reaches an area, look at that, and the triggers don't break, guess what? No short trades. Look at that bounce, ladies and gentlemen. There's resistance holding. There's a divergence line holding. Resistance holding, divergence line holding, divergence line holding. Rule number two will keep you out of a market that's consolidating. Rule number two will give you the opportunity to not trade into areas that may stop the market. And this is what, 1, 2, 3, 4, 5, 6, 7, 8, 9, maybe 9 losers avoided through rule number two. And then if you back up a little bit, you'll see that the whole push down started at resistance with no triggers through. That was another consolidation. And there's resistance and it pushes down, and there's support and it pushes up. So go back and circle these, learn these, look at these, get comfortable with the idea that a clear path can pay huge dividends for you. And when you couple with momentum, oh my gosh, you're darn near unstoppable. But not only do you have to recognize when areas may stop the market, when is the path clear, guys? When do I not have to worry about it? It's easy to find the danger. Let's make sure that we find the opportunity as well. When the smalls and the large, small triggers and large triggers, get to the other side of the area in question, well, that area is broken. The path is clear until you reach the next area. And it really can be that simple, guys. If price reaches and the triggers remain above support, below resistance, do absolutely nothing. Sit on your hands. Wait for the opportunities. If the small and the large get to the other side of support, support behaves as resistance. I'm going to couple that clear path with the advantage of momentum. And then you guys, Mira Boy, you're going to pinpoint on that smaller, faster chart exactly where this tail is most likely to form. You're going to use that pullback. You're going to find areas inside of favorable large triggers, and that becomes your short to use the momentum to get to the next area. So two options for new users. If price reaches an area, the triggers remain below, this is a termination condition. Rule number two isn't met. If small and large get to the other side of the area in question, small and large get above resistance. Resistance begins to behave as support. When you have odds favorable momentum and a clear path, you're going to be able to pinpoint where that tail is most likely to form. One of the misconceptions that a lot of people have is that it's the color of the fib. But Mark, the fib was blue. Triggers lead the way, guys. Triggers tell you if it's likely to hold. Triggers tell you if it's likely to break. Triggers tell you if it's broken. Don't get caught up on colors. Let the triggers lead the way. Because sometimes areas have the potential to break. Sometimes your small triggers will absolutely smash through an area, 3 to 4 points worth. But because the large triggers are a little slower moving, they're going to lag behind. They're not going to be through that area. The path won't be clear. With this much momentum and the small triggers smashing through, this area has the potential to break. 69.80 has the potential to break, but it's not broken yet. It will only be considered broken when the small and large are above. So this is going to be one of those times, guys, where we're speaking in terms of advantages, is going to tell you that it has the potential, but it's not broken. So I need to manage a little more aggressively. This is actually going to be your first medium probability trade. I'm going to give you a plan how to take it. But a medium probability trade means that most of your indicators line up for the trade. However, a small issue exists. Your small issue will be that it only has the potential to break. It's not broken, which means that you may manage assertively. You might take quicker profits. You might get to a zero loss level because what you'll find is that the potential to break doesn't guarantee a break. So I'm going to give you a rock solid plan to take it. And then once again, if we just go back to the live market, what you'll notice is that the potential to break is real, but it doesn't always break. The potential for areas to break, you're going to see it all day long. But you've got to be aware. You've got to be a chart reader so that you can decide whether or not it's worth it to take a shot. So, is everybody comfortable with the idea? Separation between the small and the large lets me know that this is a market that's likely to continue in the direction of the trend. Rule number one is defined on the large chart. Rule number two says if that price reaches an area and the triggers remain above support, below resistance, it's okay to sit on your hands and do nothing. Remember, guys, 90% of your day is going to be spent reading indicators. 90% of your day is going to be waiting for advantages, waiting for the absolute best of the best. And this is one of my favorite pictures to share in class because Woo, the market is absolutely screaming to the downside. Odds favorable momentum. If you are in a trade, this becomes a great target. But if you weren't in a trade, these one-to-ones with all of the trigger lines above just says, hey, be patient. This isn't your money yet. Not yet, John 20. Not yet, Paul Flowers. Not yet, Parker. Let's just sit for a second. Let's go build a sandwich. And look at the bounce. This is what I would call an untradeable bounce. I can't get short into this area of support, but I also can't get long into this area of resistance. All of my triggers are below. And then I can't help but notice that my trigger lines don't agree with one another or the background color, and I don't have the advantage of momentum. And guys, this little untradeable bounce goes on for about 45 minutes. And this is where you have to make a decision. This is your 90%. This is you can do nothing. It costs nothing to do that. Or you can hope, Parker, you can chase the money. You can hope, you can wish, you can pray, you can want. And honestly, when the market is doing this, this is where I see people giving an awful lot of money away. Nexgen, very simple set of rules, very, very basic methodology, keeps you out of this fight. But I want you to see the 10%. The 10% is when the smalls are outside of the large, when the triggers finally clear the area, and then where you can pinpoint where that tail is most likely to form, guys. This is your 10%. This particular trade is about a $450 trade. Wouldn't it just absolutely suck, and that's a technical term, to still be down $500 after taking the perfect trade? $877 cash now, but old gold. That advertisement lives rent-free in your head. Guys, what you do when there's nothing to do, or more appropriately, what you don't do when there's nothing to do is probably going to be a better indication of how much of this money you get to keep. And I see people all the time. I'm going to take the wrong trade. I'm going to hope that it works. And when it doesn't, they start to get a little angry, a little dejected. So they break the rules again. That revenge trade comes in. If you can sit through this and say, this isn't my money, this isn't my trade, eventually your trade will come along. Thank you, Muser, for that. When you stop trying to fabricate trades, the right trades tend to come along. And then my brother's old analogy, if you walk into the bank and you say, give me all the money, you're a bank robber. You're going to get tased and hogtied, guys. You're going to federal penitentiary. But if you walk in and you say, may I have my money, please? May I have the money that has been created through momentum, a clear path, and an entry area? May I have the money that gives me a statistical advantage? Well, now you're not a bank robber. Now you're just a customer, and you typically walk out without the money. So termination conditions, guys. Large chart defines lines that could be problematic. This is a large chart thing. Large chart says up. Large chart says areas. Large chart defines momentum. But there is one termination condition that can happen on a smaller, faster chart. And there's only one termination condition that I look for in a smaller, faster chart. And that's the idea that divergence, three divergences in the same location may terminate the trend. What is divergence? Divergence is a loss of momentum. If price goes down and back up, that's a pivot, guys. That's nothing more than a pivot. It's just an up and down. If that pivot momentum doesn't follow price, well, then your software is going to run calculations. Your software is going to print a negative number. Bigger numbers aren't stronger than smaller numbers, guys. It's just a number. It's a byproduct of the calculations. But it's going to also print this cyan line from a low, this divergence line from a high, this magenta. If you see that line, there was a loss of momentum. But if you see three losses of momentum in the same price range, well, that may terminate the trend. Three losses of momentum in the same price range with weak triggers, the same lesson from rule number 1, becomes more powerful. Three divergences with weak triggers and a third pivot higher than the previous or lower than the previous from a high makes it even more powerful. Never guaranteed to stop the market, but If I see these three divergences in the same price range, rule number 2 is not met. Good morning, Kenan. I don't have a clear path. And you're going to see these three divergences on a smaller, faster chart before you'll see them on a large chart, because the large chart is slow. So this at a low and this at a high is going to help you recognize where even with a clear path, maybe it's time to pump the brakes and not take that last short. Or maybe with odds favorable in a clear path, that long is less likely to work because those three divergences print. And guys, that is large chart. Large chart leads the way. I'm going to put that on coffee cups one day. So I want you guys to give me a why in the room, if you will. I ask for a lot of whys because it's important to me that you guys understand this. I'm pretty good at it at this point, and sometimes I miss it. So check out my large chart right now, most current bar. The background is green, and the market's going up. My small triggers are above the large triggers. There's space between the two. Guess what? I have momentum. I haven't reached resistance, but I've cleared the previous resistance. It's behaving as support. I have a clear path, guys. My large chart says, hey, Mark, let's look for an entry. Let's look for the small crowd to do their thing. Let's let the small crowd fight everything the large crowd is saying. We'll take advantage of their silliness, and we're going to do that through rule number 3. You guys are going to use a limit order, and you're going to use it to buy or sell a pullback at an area inside of favorable large triggers. You are going to literally call your shots and wait with a limit order for the market to come to you. That limit order is going to be at areas. The way we use lines on the large chart to define problems, we're going to use lines on the small chart to define areas where the market may bounce. But the key is we want those areas to be inside of triggers, guys. Inside of triggers. And we do that because the limit order has us waiting. The small crowd gives the pushback. The areas give us something to bounce off of. And the triggers give us a correction point. The triggers are moving averages. That's all they are. There's a lot of math that's way above my pay grade that creates them. But what I do know is that price tends to come back to those moving averages. So we use them on the small chart to define where the areas should be. So there's two trigger looks. There's favorable large triggers when the large triggers and the synthetic triggers on the small chart are overlapping, one on top of the other, super tight, like snakes riding piggyback. The synthetic triggers are the large triggers from the large chart, and then we have the large triggers on the small chart that help us define momentum. And what happens, whoops, wrong way, is when they're one on top of the other, guys, there's just not a lot of room to shove an area in there, which means that it's more precise, that you can minimize your risk, that you can pinpoint more accurately. If your large triggers and your synthetic triggers start to separate or split, as we call it in the room, you have 2 points where the market may be correcting. You have 2 points where price has the potential to go. And there's going to be different factors that come in. You will, as a chart reader, know when it's okay to take a shot with this look. But as a brand new user, I do a lot of blanketing, guys. And this is one of the best blankets I can give you, is keep it conservative, keep it focused, embrace favorable large triggers first. And then we're just going to put the two charts together. So Miraboy, here's where the magic happens. A lot of amazing things happen with this methodology. The first thing is it gives you very simple rules, guys. If there is odds favorable momentum, well, then I look for a clear path. Rule number 1 has to be met to look for rule number 2. Smalls and large are above resistance. It's behaving as support. Rule number 2 has to be met before I look for rule number 3. But here's kind of the thing that this is where the confusion comes in for new users a little bit. The top of this bar is where we're making the decision to look for an entry, not the wick. The top of this bar is the beginning of the pullback, right? And you may say to yourself, well, Mark, there's not a lot of room to get to resistance. I'm here to make money. And this is where the magic happens. This pullback on the small chart is this tail on the large chart. Your distance to your target grows exponentially by waiting for the pullback. So all you have to do is give me about 20 days, guys, where you can pinpoint where the market is most likely to continue. And there's Just an order of operations to make it happen. The first thing on your small chart when the rules are met on the large chart is you wait for a reversal bar. What's a reversal bar? It just signals the pullback. It says, hey, the small crowd is getting ready to fight. The reversal bar is not my entry. The reversal bar says, hey, Mark, let's look for the trigger lines. Let's look for that correction point. And I'm going to draw a box mentally, physically, whatever, from the highest line of the triggers to the lowest line of the triggers. That's it. Large triggers, synthetic triggers. And this red box lets me know exactly where I need to look for areas because my rules say that I'm going to buy or sell a pullback at an area inside of favorable large triggers. So when price reaches the large triggers, that's not my entry. I'm still waiting for areas. So I'm looking for fibs, I'm looking for mid bands, and I'm looking for yellow 1-to-1s inside of favorable large triggers. Once you identify the areas inside of favorable large triggers, you can create what I like to call the window of opportunity. The window of opportunity is the point where the market is most likely to form. Nope, Miraboy, yellow dots are 1-to-1s. Yellow dots can behave as support or resistance. Synthetics are these, see the stepped large triggers? Those are your synthetic triggers. Your synthetic triggers are the large triggers from the large chart. Anytime Nexgen says synthetic, it means that it's pulled from a different time frame. So what we do, Miraboy, is when, no, you're good, don't be sorry, is when we transpose these triggers onto the small chart and both sets of large triggers are trending together, there's less room for areas. There's less point where the market is most likely to continue. Your window of opportunity for a long trade will extend from the highest point of support, this mid-band, to the lowest point of support, these yellow 1-to-1s, inside of favorable large triggers, guys. And if you're brand new, I want you writing these rules on the chart. I want you literally saying every time you take a high probability trend trade, I traded from the areas inside of favorable large triggers. And what it's going to do is it's going to help you pinpoint where the market is most likely to continue. In a downtrend, when we're looking for shorts, the process is the same. The reversal bar prints signaling the beginning of a pullback. My entry is not at the reversal bar. First, I find my large triggers, my synthetic triggers, one on top of the other. My entry is not at the trigger lines. And then I identify the areas inside of the trigger lines. In this case, all it is a mid-band. Guys, there is one line inside of favorable large triggers. This is where the market is most likely to continue. The only thing that I have to do is activate a limit order just below it. I have pinpointed with amazing accuracy where the market is most likely to continue. Areas beyond the triggers, beyond the correction point, are not a part of the window. That's it, guys. So, Mira, we don't trade the tail. The tail is all the way up here. When you know a tail is there, the market's all the way here. We're going to trade that pullback to the area inside of favorable large triggers. We're going to patiently wait. We're going to pinpoint. And the coolest thing about this, guys, is that once you know where the market is most likely to continue, you know where the market shouldn't go. The market shouldn't go beyond that correction point. It shouldn't go beyond those triggers, beyond those areas inside of the triggers. And this is where your first protective stop is going to be. Your first protective stop is going to be where the market shouldn't go. I want you to embrace that language, where the market shouldn't go. Generally 4 to 5 ticks above all the trigger lines and the entry support or resistance areas, guys. Classroom verbiage calls it the window of opportunity. And then after the market confirms the trade with a reversal bar, down bar, up bar, and along, you can reduce your risk a couple ticks above that reversal bar, a couple ticks below that reversal bar. And let's go through one of the realities of trading for everybody that's in here. For anybody that maybe isn't familiar with trading. Anything that wins 70 to 80% of the time is going to lose 20 to 30% of the time, which means that every 10 trades that you take, you should expect it to hit that stop, to take you out of the market. And this is a cost of doing business, and it's a very normal part of a positive equity curve. And because we have momentum, because we have a clear path, because we define the entry area, we're reducing our losses. We're taking smaller winners or smaller losers than winners. And it's not uncommon to see you guys post in the room trades that fail, even though the rules were met, even though the entry was perfect. Get that reversal bar, reduce risk behind it, and taking 2 to 3 ticks loss instead of $200 to $300, guys. And we manage our risk long before we ever manage our profits, and we do that through the advantages. So, and then let me do one more picture, and this is, and Miraboy, I know you said that you have it, but I'm a big fan of lessons. I just want to remind you guys that we're not trading the tails. We are not trading the tails. What we're trading is pullbacks to areas inside of favorable large triggers. And we're using these tails for historical study. And that's exactly where the tails come in, is when we go back and we circle these tails on our charts, right? So, man, that's a pretty good run. Let's go to crude. I think crude may have a couple extra opportunities. If I go back and I circle the tails and I have odds favorable and areas have the potential to break, what I can do is I can study it. I can take a picture and I can say, man, that pattern does work. That is a look that typically produces results. Odds favorable momentum does create a market that typically pushes in the direction of the trend. The market does tend to pull back to support or resistance inside of favorable large triggers. And what you're doing is you're taking a zero pressure, no risk, 100% just looking, circling. Guys, look at that. That is support damn near to the tick. We didn't trade the tail, we trade the pullback. And it's still going with all the momentum. And it's pretty outstanding just how often this happens. So I give you this so that you can learn this look, so you can catch this look, so that you never miss this look, so that you develop trust, you remove all doubts about this look. And the easiest way to do that is we're going to go back to the spreadsheet, guys. And the second tab is the 101 tab. And this is where I start giving you guys all the gifts. And I'm going to give you a chart reading 101 form. You just got 54 ticks on that exact look. In crude oil, Morgan, please do, because I can't wait to see it. And Morgan, can I put you on the spot for a second? Because one of the things is no, not a roast at all. Morgan, you've been with me for 2 weeks. Is that right? 3 weeks now, maybe? And within May 7th, so 13 days. In 13 days, Morgan has kept it simple, kept it focused. He's embracing the ideas that create advantages. And if that were crude oil, Morgan, that's a $540 trade, right? And if it's the NASDAQ, it's a $270 trade. And the reality is, guys, is I'm about to give you some stuff that if you keep it focused, you will have the opportunity to become profitable while you continue to learn these looks. So the easiest way to do it is to know what you're looking for. So to get to where you want to be, you've got to recognize some very basic looks and patterns. And this is going to reinforce the lessons. This is going to speed up the process of becoming a chart reader. And I'm going to tell you guys right now, in all honesty, most of you won't do this because it feels like work. I'm telling you, as someone that's been teaching this classroom for over 3 years, that this is the fastest way to get to where you want to be. Most of you won't do it because it feels like work. Most of you would rather focus on making money than learning lessons. And I'm telling you right now, if you do this, you're going to wake up this time next week and you're going to be like, holy crap, I can't miss these trades. I never second guess these trades. Take 25 pictures of strong triggers. Morgan, did it help? 25 pictures each, guys. Strong triggers, weak triggers, clear path, termination conditions. Take some of those 50-50 looks. Take your entries, your exits. Commit these looks to memory. But don't just take pictures. No, this is from my crazy little brain, Mira. This is me spending 3 years teaching people how to trade the markets and taking every lesson that I've ever given, every mistake that I've ever made, and taking everything that I've ever seen produce the fastest results for people and trying to turn it into very simple lessons for my classroom today. That's all this is. But you can't just take the pictures. You have to talk about why. So don't just take strong triggers. Now I'm going to show you from here. Don't just take a picture of strong triggers. Say that they're all green. Say that smalls are above the large with space between the two, right? Talk about odds favorable momentum. Go through it. This is why they're strong triggers. This is what it means to me in terms of advantages. This is what it means to me. Oh, I'm going to give you everything, I promise. This is what it means to me in disadvantages. If it's a termination condition, right? Let's just take a picture real quick. If it's a termination condition, price reaches divergence high, triggers remain below. This is how I identified it. This is a termination condition. Rule number 2 isn't met. It's not a clear path. And if you guys go through this, and you do this for each individual picture, if you type out the advantages, if you spend the time analyzing, posting it in the spreadsheet, and if you're not sure if you have it right, ask for help. What's going to happen is you're going to piece together the looks that create a trade. You're going to take the individual parts and you're going to turn them into the trade. So here is the 101 thing, guys. There's the chart reading 101, Miraboy. But even more so, let me make it easier on you. Here's a high probability trend trade checklist, guys, with pictures of what everything is. This is what every picture of strong triggers looks like. Malcolm, do me a favor. So Malcolm, go to your small chart, and this happens sometimes on Monday mornings. I don't know why. There's a gap in it. Man, I got a lot of stuff open. Right click and hit reload all historical data, then put your hands in the air until it reloads. And that typically will fix what ails you. So let's try that before you hit up tech support, because I think it's a pretty easy fix. Right click on the chart, reload all historical data, and let me know if that works. And that should take good care of you. There you go. Look at me, guys. I'm smarter than I look. You betcha. So as you go back and take pictures of strong triggers, there's only 2 looks. And if you go back and take pictures of weak triggers, you know exactly what it looks like. And if you're identifying termination conditions, that's your termination, that's your clear path, that's your 50-50, that's your window of opportunity short, that's your window of opportunity long. Guys, there's something about the data over the weekend. I have to do that with every chart Monday morning. I just right click, reload, and it goes back and hits all the historical. Awesome, Paul. I'm glad that worked for you too. So use not only the chart reading 101 to take pictures, to know exactly what it is that you're looking for. Take this spreadsheet, those checklists in the room that I just gave you that identifies them visually. Police yourself a little bit. I'm also going to drop a checklist in the room right now. This is the high probability trend trade checklist. I've never, ever in the history of this checklist had people actually follow these rules to the letter and do worse than 70%. Guys, the whole goal of trading is to get paid. The whole goal of trading is to put yourself in a position where every time you take a trade, you're trading a pattern that has been proven to win more than it loses. And I don't want any of you to take my word for it. I don't want any of you to ever say, Mark said this wins more than it loses. I want you to go back and I want you to find these trades, to circle those tails, to annotate charts, and I want you to prove it to yourself. And what I'll find is that if you guys put the work in and hopefully do it to prove me wrong, right? You're going to be with me for the rest of your life. You're not going anywhere because all you have to do is spend a couple hours doing this and you realize that it does in fact work. You just have to learn how to work it. So I'm going to give you the checklist. Guys, print this out, put it on your desktop. Police yourself. Write these rules on your chart every time you annotate a trade. And then finally, I'm going to give you one more, guys. I'm going to give you the KISS plan. And the KISS plan is a stepping stone in your learning journey. I love the way that sounds. It's a stepping stone. Guys, this isn't the end-all be-all. The KISS plan is designed to optimize your chances of success with a high probability trend trade and that 50-50 trade, that one where the area is not quite broken but has the potential to break. Through simulation, through study, through class feedback, continuous practice. You will be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. I can't read that not in a sarcastic voice. That's my brother playing with AI one day. And what it says, guys, is when you're a chart reader, right? John Twinney, Paul W., Jonathan Christopher, Wayne, Donna, Kenny, Dan, Kenan, Hamid. When you're a chart reader, you're going to see stuff. You're going to recognize patterns. You're going to find more trades, and you're going to realize that there's a whole lot more going on in the market than you realize as a brand new user, and you're going to find ways to take advantage of it. But until you become a chart reader, until you're comfortable and confident in recognizing momentum, a clear path, in an entry area, keep it simple. Let it be easy. Focus on one thing and get great at it. And your simple plan for consistency, guys, it begins with never fight the large chart. My biggest hurdle in the beginning was fighting the large chart. Most new users fight the large chart in the beginning because we get excited and we want to be in trades, guys. And this is how you commit financial suicide. This is a book my brother wrote, very tongue-in-cheek. I hope you don't find it offensive. But chapter 1, warning signs your friends are in trouble, guys. They're trading against strong triggers. Chapter 2, your friends aren't paying attention. They trade into termination conditions. These are the two most common mistakes that new users make. So my brother said, you know what, let's make a silly little book about it. And if you do that, if you never fight the large chart, you are already about 60 to 70% better than the average user because you're not trading opinions, you're trading advantages. So you have to define your entry, personalize it, make it yours. My entries will never be your entries, guys. We're in a different place, right? My entries are my entries. They're my rules. I have to be held accountable to my rules. Your entries are your entries. They're your rules. I'll hold you accountable to the rules that you write on the chart. But once you can define your entry, you are in such a good position, but you're going to have to manage that trade. Once you can get in, it really is, Gerard. You're going to have to manage it. You're going to have to do something with that great entry. So your management plan as a brand new user should be just as mechanical as your entries as a brand new user. Your management plan should eliminate fear and greed and hope and wish and want. You know, my father-in-law used to say, wish in one hand, poop in the other, but he didn't say poop. And he'd say, son, tell me which one fills up first. One of the great things about what we do, guys, is we don't have to hope. We know that when we enter, we have a statistical advantage, and now we're going to manage it. So your super basic management plan is dependent on your great entries, but you will create a management plan suited to your needs based on your chart reading as you grow with the software. So the first part of it is get in where the market is most likely to continue. Because if you do this, you know where the market shouldn't go, and that's your initial stop. And you're going to sit on your hands, and no matter how scared you become, you're going to let this thing play out. It's either going to come up, hit your stop, it's not your money. It wasn't meant to be. It's a cost of doing business. It's a normal part of a positive equity curve. Or trade's going to go in your direction, guys, and it's going to give you a reversal bar. With all those advantages, this happens more often than it doesn't. And once this happens, you're going to reduce your risk. So let it be very if-then in the beginning. If I get a reversal bar in the direction of my trade, then I will put my stop 2 ticks above that reversal bar, or for a long trade, I will put my stop 2 ticks below that reversal bar. And then I'm going to slide my chair 6 feet from my keyboard, 8 feet from my mouse, and I'm not going to do a darn thing. And they're either going to stop me out for a smaller loss, or my first target gets hit. And for you brand new users, embracing these advantages, your first target on the KISS plan is only $100 in the distance, which means you are 10 ticks away typically from confidence. You are 10 ticks away from feeling good about the trade, from feeling great, from getting paid, from it going the account, from hearing NinjaTrader telling you, way to be awesome, right? And it feels good, guys, and success builds confidence. So you're also going to go break even. You're going to say, you know what? I just got paid and I'm not going to leave anything on this trade. And the only reason we go break even as brand new users when we're this close to our entry is because you're developing trust in the idea that the large chart leads the way. You're developing trust that strong triggers and a clear path is more likely to push the market down than have it experience a full reversal. So what you're going to do is you're going to be able to hold. Zero risk, money in the bank, let me hold. And it's going to keep you from focusing on little fluctuations on the small chart. And if you hit that second target, it's only $200 in the distance, which means that 2 contracts, 1 trade, every advantage, just put $300 into your account. And the wonderful thing is that's the best you do every day. Even if it's 3 break-even trades, right? $1,500 a week. And that translates to $6,000 a month. And suddenly that $100, that $200 doesn't sound so bad. And that's a $72,000 years, guys, from the most pragmatic, basic, mechanical, emotionless approach that we know how to teach for trading. And the cool thing is that the more you study this, the more you practice this, the more trust that you build in the market, the more likely you are to find a long trade somewhere in here, right? The more likely you are to take advantage of that termination that creates a full reversal. The more likely you are to get paid even without odds favorable momentum. All of that chart reading comes together to create dividends. But if you allow it to be simple in the beginning, and price reaches resistance and none of the triggers break through, you say to yourself, I just don't have a long trade. I have to be patient. So I'm going to ask one more time, guys, and I think I put everything in there. I'm going to do it all at once real quick. I'm going to give you chart reading 101. I'm going to give you both checklists. I'm going to give you the KISS plan. I'm going to give you my spreadsheet, and I'm going to give you the PowerPoint that I use to teach this classroom every morning. Each and every one of those just went into the room. I would encourage you, I can't command you, I would encourage you to go through that 101 drill, to fill out that section of your spreadsheet that gets you recognizing advantages individually. I would encourage you to keep it simple, to keep it focused, to get really good at one thing before you break out and try to do other things. And once you're a chart reader, guys, once you have these very basic ideas down, once you're good at finding the entry on the high probability trend trade, you're going to open doors for the 50-50 trade. That trade where the area isn't broken, but it has the potential to break. And then once again, guys, there's a very, very clear spreadsheet or checklist for finding your entries. It all revolves around momentum. And it tells you divergence kills it. This is the most lost trade among new users. And that's it right there. Bright red, no divergence, no divergence. Even your management says, get the hell out of divergence prints. Guess what kills 50-50 trades? Losses of momentum. Why? Because we already don't have a clear path. We're giving away 66% of our advantages, guys. So go through it, take a million pictures, post every one of them in the room. Ask for help, ask for feedback. If it won't let you add letters to your boxes, hold on, Jonathan. Where's your box? So do me a favor. When you do your box, I'm going to show you real quick. Get back up there. If your box is black, you're never going to see my black type. That's a pretty big one. So make your box white, and when you click, and you have to click and hold down, Jonathan, and go like this. Are you comfortable creating the box? I think maybe you're just clicking. You have to click and drag. Click and drag. Because I see some tiny little arrows on your picture, which means that you may have clicked but didn't drag. So left click, hold down, and make it big. Are you able to make the box bigger? This is so important. We're going to get this. Awesome. So do you see the blinking cursor in the middle? This lets me know that I'm ready to type. If you don't have that blinking cursor, like if you do the box and then you click someplace else, that cursor goes away. So give me two quick clicks right in the middle. Pop up. Left click twice really fast. And it should put that blinking line in there. Will you try that for me real quick? And what's cool is these are the mistakes that I've made as well. So I know the fix. 2 quick clicks gives you that, and then it's off to the races. And then you get to share every thought that you have with me. Let me know if that works for you. And guys, that goes for everybody. If you have a question, and even if it doesn't have anything to do with momentum, a clear path at our entry area, please put it in the room. Let's find an answer for you. And if I don't have the answers, I know the people that do. And I will find answers for you. But Right now, what we're going to do, or what I'm going to do, because, you got to do this, is I'm going to go take a break. Oh, man, hold it. Did this just happen again, guys? Son of a gun. More money to be made, ladies and gentlemen. We'll go back and talk about it. But I'm going to take a break real quick. I'm going to go stretch my legs, scratch my dog, say hey to my sister-in-law. And when I come back in 5 minutes, we're going to start looking at all the pictures that you guys are posting. We're going to answer all the questions that you have. And everybody gets one step closer to their goal today. So I'll see you guys in about 5 minutes. Mic silence. Post them if you got them. Hey, Miss Ellie. Whoa! Oh my gosh, that is beautiful! You did such a good job! Are you going on an airplane today? Yes. Oh, and cakes? And Mickey Mouse? Oh my goodness. You did such a great job on those. Is Grandma sitting on the couch? You are so talented. You have to leave me those pictures so I can put them all on my refrigerator. And I'm teaching a class. Did you know that I'm a teacher? So I have to go teach my class. Yeah, balloons. You're drawing balloons. I love it. Beautiful. Great job. Ellie, you gotta come here. Come on, let's go teach. Come on, let's go to work. You come on? You wanna come to class? Alright. I have to teach. I love you. Alright. We gotta get back to work. Alright, get your toys. All right, y'all. Let's get back to work. I'm too excited. We got to work. So what I'm going to do, and Jonathan, did that work out? Jonathan Christoph, were you able to get a couple words in those boxes? Just want to make sure. All right, guys. So I'm going to scroll up to the very top of the chat box. Awesome. I'm telling you guys, there's absolutely nothing that we can't fix. If all you got to do is tell me there's a problem. I'm going to scroll up to the top, and we're going to start looking at some of the charts that were posted. And guys, I get pictures from the weekend all the time. And I don't mind going back and taking a look at them. So what I'm going to do is I'm going to, Paul's given us about 4 or 5 of them. So I'm going to click on all of Paul's. And we're just going to start looking at what he's doing, what he sees, what he's thinking. And we're going to look at advantages, and we're going to look for disadvantages, and we're going to talk about entries and exits and all those wonderful things, guys. And he got us going here, and I hope everyone can see it. And look at the momentum on his chart. And he hasn't reached the area yet, and his path is clear. And the market pulls right back to a mid-band, lowest point of the area. He gets in, and he makes money all the way down. And guys, this is the kind of trade that you should steal from Paul, and you should go to your spreadsheet and you should drop it into your favorite looks and say something clever like, never miss this look. It's perfect. It's everything that you could ever hope for in a trade. It is momentum. It is a clear path. It's a pullback to areas inside of favorable large triggers. And it's some of the easiest money that you are ever going to make as a next-gen user when you have all these advantages together. And then you start to go next level. And Paul, I saw this one this morning and I was so excited about it. Guys, when a termination condition reverses the market, that's a strong bottom. That's a strong top. That's the best of the best. And I was saying that when a termination reverses the market, guys, can everybody hear me? I just want to make sure. Okay, yeah, I think so, because Jonathan Christoph said he could. When a termination reverses the market, guys, it's powerful. And you'll notice that Paul didn't take a high probability trend trade here because the large are down and the synthetic are flat and it's kind of ugly and there's a mid band. But what happens is when you become a chart reader, you start putting a lot of faith in these great terminations. And you say, well, when this market terminates and things start to roll, I can use a little momentum on the small chart to capitalize up to the next area. And Paul, you could not have taken this trade any better. It is not a high probability trend trade. It does not have odds favorable momentum, but what it does have is a termination that reversed the market. It is an indication that things are changing on the small chart, and it is the immediate momentum coming off of that low. And I think you absolutely nailed that trade. And here we have one of those 50-50 trades come again, once again, from a strong top, from a termination that reverses the market. Odds favorable momentum with the potential to break. And Paul says, with no divergence, strong triggers. I expect it to get to the triggers, but my only area is a few ticks below. Let me get in at the area, understanding where my stop goes. And Paul, easy money. Once again, you're really making it look effortless here. And then everything is down. And the path is clear, and the entry is perfect, and this one dances a little bit, the fluctuations. And Paul, I know that you remembered this from classroom, but guys, this is a great example of when you're chart reading, when your ability to understand the charts a little better will change your management plan. And I want to show you what I mean here, and we're going to do this in pictures real quick. And I like this hold. And guys, for the brand new user, this hold is very difficult. For the more experienced user, it begins to make sense because everything starts on the large chart. And the large chart, without a doubt, has odds favorable momentum and a clear path. And that's the best of the best. And it's coming from a termination that reversed the market. You couldn't find a better look. Like, you could shop for years. You wouldn't find a better look. And then Paul's window of opportunity is this big, from the mid-band to the one-to-ones inside of favorable large triggers, which means that his stop, per the rules, goes about right there, right above that Fibonacci resistance, and that's about his 4 to 5 ticks. His entry is perfect, and then that 5-1 does the dance that the 5-1 does sometimes. Some people get out right here. Some people panic. Some people don't hold. But the reality is it pretty much stays inside of that window, and then it continues down with everything that the large chart said that it was going to do. And this is a hold that if you use the reversal bar, you probably got stopped out. And then you may have to re-enter, or you may choose not to re-enter. But Paul remembered this one from the day, so I'm going to show you how the average user would take this one, because there's a lot of great lessons on this one. If you took this entry, your stop was right here. And you got stopped out, guys. You lost, I don't know, maybe a point. If this is the S&P. No, probably like 7 ticks. And then what happens is, as you grow with the software, your brain is going to say, but self. I have odds favorable momentum. I have a clear path. I'm coming from a termination condition. You know what? It did a dance, but if it gives me confirmation of the trade again, the large chart still says take a trade, and that's exactly what Paul did here. So, Paul, absolutely outstanding trading so far on everything that you're showing me. Nice job. And then you start to get risky, right? Then you start to get those simulator, that testicular fortitude where you start really giving away advantages. And man, Paul, you don't have momentum. You're trading directly into termination conditions, um, and you're doing it on a market that's been clearly consolidating. Your triggers are flat; they're pretty lifeless. So we're gonna find both sides of the coin. You are directly into termination conditions, and you don't even have odds favorable momentum to suggest that they're going to break. Um, but you do have this level of support right here with everything coming through, with every trigger up. And you said, you know what? I'm willing to give it a shot. And you manage aggressively. And I'm not sure why you put your stop just above the same mid band you got in at. And it continues up. These are the trades, and I just have to say it, and I love that you got paid on it, and I think that has a little bit to do that you remembered it with your market replay. These are the trades, guys, that lose more than they win. These are the trades in determination conditions with weak triggers that simply lose more than they win. And while it feels good to make a little money on these, going back on playback, use market replay, guys, to test your rules. Use market replay to follow your rules. Use market replay not to break your rules and get all pumped up about the idea that you made a bunch of money, a lot of pretend simulator money. Really focus on rule adherence. And I think that pays dividends. So, Paul, great charts. Great trades, a lot of good information, some awesome lessons on when to hold. I appreciate you posting in there. And then Pinieski, who I don't believe is in the room, says with odds favorable momentum coming from a termination, didn't take the first entry, got the second one, used a third chart for a little confirmation, and everything tends to go up. And then Jen, when a termination creates a reversal, gives you odds favorable momentum, you better believe you're taking the pullback to resistance right there at the triggers, and you make money all the way down until divergence and weak triggers says let's take a break. And if I'm not mistaken, that could have been another shot. Nice job. Absolutely. And momentum for the win. Right? Momentum for the win. Momentum for the win. One of the great things about these charts, guys, is when you see other people using the software, you're going to see momentum for the win quite a bit. You're going to see momentum for the win, clear path for the win, and you're going to begin to trust it. So make sure that you're doing that. And then, Paul, weak bottom, didn't touch the fib, but not good for a termination. The picture that I put in the room for this one, guys, is you're going to have times, all the times, where the market stops a tick away from a fib, where the market overruns a fib. And I like to use this as an example, and I like to bring this conversation up in the room, that when you open your software, guys, it runs through thousands of calculations, and it does every measurement of every up, down, left, right, swing, everything in the market. And it creates all these Fibonacci retracements and all these different things. And then from all of these calculations, that is how you get these fibs. So if price misses a fib by a tick, it's in the area. If price overruns a fib by a tick or two, it's in the area, right? You see it right there. But what happens is fibs are an accumulation of thousands of calculations. Divergence lows are one number, very precise. Yellow 1-to-1s are one number, very precise. So what I was posting in the room for Paul is that when you get to this area and you're considering a short trade, and I'm sure that's what it was, right, Paul? Is you're saying to yourself, man, do I take the short trade here? Well, then you're going to look at other factors. You're going to say to yourself, do I have divergence on the small chart? Do I still have strong triggers? Do I have a clearly defined area? Do I have enough advantages to say, even though the market, and I think that was this morning, right? Do I have enough advantages down here to say that I'll take one more shot at it? Was this it right here at 9:07, or was it back at 6 a.m.? Because that looks very familiar. So when you start getting areas beyond, right? When you start getting divergences off that's so close to the fib but not quite to the fib, this is enough to tell me, hey, it's a tick off, but I'm probably not going to take it. Does that make sense, Paul? So there'll be times where you guys will have to say, it didn't quite touch it. Do I want to try another short? Well, I don't really have areas inside of favorable large triggers. I'm losing momentum. I don't have the best of the best. I don't think I want to take it there. So great lesson again, guys. How do we feel about that termination? At 9:07, the market started running up. At 10:20, at 10:09, it stopped on a dime at Fibonacci resistance. These are the pictures that I want you guys taking. Because the more times you see this happen, the more likely you are to pump the brakes and not take that next long. So good stuff. All right, who's next? I love chart reads, guys. I love going through this part of the room. And then once we're done with all the chart reading, we'll go through and we'll start looking at the live market a little bit too. See what happens. Jonathan Christoph, let's see what you got. All right, so I told you that we would annotate this one together. And we're going to. So guys, when I see something like this, I'm going to look 100% on the advantages taught in class. And I'm going to start with the large chart. And I'm going to ask myself, I always start with momentum. So do I have momentum? Let's see, the smalls are below the large. I like that. Both are red. I like that. Space between. Both opening in direction of trend. Guys, do I have odds favorable momentum? Can we all agree conclusively that yes, that momentum is there? I hope so. I feel like we can. But then I have to ask myself, do I have a clear path? Price reaches Fibonacci support, and all of my triggers remain above. So what I don't have is a clear path. There is no clear path. Jonathan, does that make sense? Rule number 1 is met. Rule number 2 is definitely not. Price reached the area, all the triggers remain above. This is like textbook. I could teach it in the room. This is an area that may stop the market, that may create a bounce. And then when you come through on your entry, you just jumped in. You're trying to take advantage of momentum. You're hoping that momentum breaks these areas. But what happens is if you're going to take these momentum trades, guys, if you're going to try to just benefit 100% from nothing but momentum, letting these small triggers break through the area you're hoping that breaks is going to give you a little bit of an advantage with that momentum. And notice that the small triggers don't make it through, and you get a bounce all the way up to a mid-band right inside of the triggers, which sounds a lot like the potential entry for a high probability trend trade. So, Jonathan, I like the direction. I like the momentum. I think that these jump-in trades require more than just hope, right? Having a clear path pays dividends. Having small triggers, at least through the area, pays dividends. Having small triggers through the area here pays dividends. Waiting for the snapback to the fib pays dividends. It's a great preliminary read on the large chart. But it's just getting a little bit excited. And you'll notice that it's not coming from a good top, right? So there's a little bit of hope going on there. But that's okay. You got to take these trades to begin to understand when not to take these trades. Erla says, I'm coming from a termination and everything says down. Let me just keep making money. And that's another example right there of the same thing, guys. If you're getting in and hoping that momentum wins, how do you react when there's not momentum, right? Erla says, well, I'm going to put all my eggs in the basket of the mid-band holding here. And that's a pretty good snapback. And I hope you see this, Erla. You're in at 47-ish, 417.8. And it pulls all the way up to 19. So 19 and change. So we're giving a lot back, hoping that the mid-band holds. And we're doing that on a momentum style entry without momentum, with a loss of momentum, right? Sometimes, and I never tell you guys how to trade. That's not my business. Sometimes you have to know what kind of trade you're in to understand how to manage it. And if you're in a trade that relies on momentum, and we call it something clever, like a momentum trade, with this look, I'm not as concerned with the pullback. With anything can happen triggers, I don't know how far this is going to pull back. So there has to be an exit condition at some point. What's it going to take to get you out of a momentum trade? Right? Is it going to be a loss of momentum? You can always re-enter with a reversal bar and ride that wave down. Or if there is a loss of momentum, rather than just jumping in, give it a chance to pull back. And this is very much without momentum. This falls into the fear of missing out category. It's not as precise. My brother told me once, he goes, if you're going to show me a momentum trade, you should be able to show me momentum on 3 charts. And I've put a lot of stock in that. I like the direction. And then when everything turns to go up, then Erla, that's where you excel right here. That's a momentum trade, right? Look at it. You've got momentum on both charts. Everything's where it needs to be, and it's freaking effortless. Can you see the difference between the two? One of these, I don't have a fear in the world. One of them, I'm hoping it goes. And that's one of the things that I stress a lot. And I say it because I believe it, is we're better than hope. Early, you're better than hope. I've seen your charts. I've seen your trades. You're better than weak triggers momentum trades. You know how to identify it. You know exactly how to capitalize it. And the hardest thing that you'll ever do is absolutely nothing. And when the market's doing that, and you couldn't find a way to get in, maybe you weren't there for that one, your brain starts taking chances. So this one right here is in the Erla Hall of Fame. No worries, Andy. We'll talk about it. And then Muser, price a full bar away from large triggers. Mid-band may act as a termination. Price may reverse. No long trade. And Muser, great recognition of the gap theory. But you know what's awesome? And Muser, you probably recognize this in the moment. So guys, the gap theory says that if price reaches, this is how the mid-band behaves as a termination. If price reaches the mid-band and the large triggers are a full bar away down here below this reversal bar, no long trades. Muser, did you recognize that price reached resistance and absolutely none of the triggers broke? That alone says no long trades. That's a termination condition. And you just kind of compounded another lesson, and your understanding of the gap theory, it kind of reinforced that you're probably not just going to jump in and hope on this trade. Great recognition. And then there it is again. Price reaches, large triggers a full bar away. You're not taking a short trade. The mid-band is way off in the distance, Muser. You're trading at 29 and the mid-band is at 26. It's $150 in the distance, but this fib has absolutely no triggers through it. So price reached the fib, large triggers are a full bar away. There's your gap theory right there. Does that make sense, Muser? And I like that you did this because this is one of the things that's going to happen to you guys is you're going to learn a lesson and then you're going to try to apply that lesson everywhere. Man, I've done it. You're going to say, man, I just learned the gap theory, and when the triggers are a full bar away, it may close the gap. And you're going to start saying, the mid-band's a termination, but the mid-band's way off in the distance. And you're going to lose sight of the simple. You're going to lose sight of the idea that we hit Fibonacci support, and absolutely none of the triggers broke through. So always start simple first, right? Momentum, areas, and then go into that secondary. Great job, Muser. Great reads. And I like that you're identifying things that are taking away your advantage and choosing not to take trades. And that's hard to do. Morgan says, Mark, I don't care about your old eyes. Did you trade into a term there? Are you with me, Morgan? Oh, you changed your work schedule. So sorry. No, you're fine, man. I love that. Good. I don't have to beat you up quick. I can beat you up slow now. How awesome is that? I'm just kidding. No violence. So did you trade into a term? Man, I'm going to do this real quick. Hold on. There we go. That's what I'm talking about. So let's go through the whole thing, Morgan. Let's do large chart read together. Because what I noticed, and call me crazy, tell me if you noticed this too. You didn't write any rules on your chart. You don't need them anymore, right? You've been with me for 13 days. I don't need rules anymore, Mark. Come on, Mama didn't raise no dummy. So let's just go through it for grins. See what we're up against. Odds favorable momentum is a definite. You have rule 1 met, and it's absolutely beautiful. That's some killer momentum. So now let's talk areas. Well, the mid-band is a term if the large triggers are a full bar away. So this area is not a termination condition. So far, so good? So let's look at the area below it. No, not gap theory. Yeah, well, the gap theory identifies it as a termination condition. So here we have, check this out. So I have the smalls above Fibonacci. Large are below, but I do have momentum. Do you remember this is the 50-50 look? 50% of, whoops, that's not it. Come back. 50% of my triggers are above the area. 50% haven't quite broken. So what do we have here? You don't have a termination condition, but you do have an area that only has the potential to break. Does that make sense? Okay, so when it only has the potential to break, there's a couple things that go on the small chart. I like blowing these up and doing this. This is kind of cool. So on the small chart, there's a couple things that I'm looking for. We're going to come back to here. And I'm going to show you why. So I already don't have a clear path. That's my large chart lead. That's not a deal breaker for me, Morgan, because momentum is amazing. So what I'm looking for is momentum, and I'm looking for that really solid entry area. Smalls are outside of the large, no divergence. That passes the first test. But do you notice how your large triggers are up here and your synthetic triggers are down here? So that's that split triggers, Morgan, which means that I essentially have 2 points where the market may correct, where those moving averages, that regression to the mean may happen. Are you with me so far? And this is for everybody, not just Morgan. So because the triggers are split, I've got a little less accuracy going on. So let's do this. Let's get rid of these boxes. And let's put a box around the only areas inside of the trigger lines. So there's my only areas that are actually inside. Whoops. These are kind of hovering. The midband is hovering in between. And that's a pretty solid look right there. So Morgan, with only the potential to break, sometimes you have to say to yourself, let's let my entry be perfect, right? Let's have odds favorable momentum. Let's have a clear path. But let's also have areas inside of favorable large triggers. And there's two ways you could have done this. You could have taken a reversal bar, and it didn't give you much room until divergence printed, and the smalls are on the wrong side, which would say, Morgan, let's get out of this trade. Or you could have waited for this reversal bar a little bit lower, and it still doesn't give you a lot of room to work through. And when I talk about the 50-50 being the most lost trade, I love that you got paid on it, but you jumped in early and you jumped out early. Can't you agree? You jumped in before the areas. That's okay. You're going to, man. You're going to panic. And one of the reasons that we go through this classroom is to try to alleviate the panic. So when I look at this trade and I put it together, I've got odds favorable momentum, but I don't have a clear path. And I'm not coming from a good bottom, which is another kind of red flag for me on the KISS trade. If I'm going through the KISS plan, whoop, that's the wrong one. That's the fill in the blanks KISS plan. So that is strike one on the trade. You're good here. You're good here. And you were actually good here. So this is one of those trades that if you entered it, and I think that you could have got in a little bit lower, at least have the area, right? Or wait for the confirmation of the reversal bar. This is still a trade that ultimately loses. This is still a trade that you have to manage out of. And it's those split triggers that let you know. It's those smalls getting to the wrong side. You took a good shot. I like it a little bit lower at the area, and this gives you more room to make some money before you panic. Nope, so it's not a good bottom, and let's talk about it. And I'm trying to make it big enough and scroll back and forth. And this is a great lesson. I'm telling you guys, these are my favorite charts, the ones that bring a lot of lessons in. Did you notice that both the small and the large made it through this fib? That's a clear path. You actually had a clear path to get to the next area. And then you get a loss of momentum with weak triggers. But since it's not coming from an area, this divergence is nothing more than a loss of momentum, Morgan. Great tops and bottoms mean that price reached the area and none of the triggers broke before the reversal. And since they all broke here, this is a pretty weak bottom, which means that this 50-50 trade is less likely to work. And a lot of times, one of the patterns that you'll see, let's see if we can find an example on crude oil real quick. Because I think this is one of those patterns that begins to create dividends. When it's a termination that reverses the bottom, this trade is more likely to work. When it is not from the fib, it's likely to continue up. When it's beyond the area, it's likely to hit that mid-band and continue up to the next key area. And you see it a lot. You'll see, here's your termination, and then that pivot's kind of from the middle of nowhere. It pulls back, but it ultimately continues up. Makes it through the area, resistance holds, the 50-50 is less likely to work, and then eventually it does continue up. So you can use this one pattern, that one thing of a good top or bottom, to increase the likelihood of success on that 50-50. And if it's not coming from a great top or bottom, you'll become a little more aggressive on how perfect your entry chart needs to be. Did all that make sense? That was a lot of talking. I know it was. Awesome. Good stuff, guys. That would have been a hard one to catch. Not gonna lie. So let's go to our next pictures. Good stuff, man. Thank you for that. User Morgan Gerard. Let's see what you have, my friend. Not a termination. So Gerard, this is the same lesson as we just gave. This is a pivot from the middle of nowhere, right? This is a pivot not coming from an area. This is a pivot that doesn't have fib support or one-to-one support or anything like that. It's literally just a pivot from nowhere. What does it mean? It means that we're not sure what's going to happen at the midband. We have to kind of look and see what's going on there. And then when that midband breaks and everything continues through, you're like, all right, they reversed the market. We're just not going to call it a strong top. So with everything down, a momentum, and the momentum is present, you take the entry right at the midband, right inside, and you put your stop, saved your bacon, and that's that small chart fluctuation, right? Notice that the large chart never blinked, Gerard, during these fluctuations. And this is a hard one to hold because it's 3 divergences in the same price range. That's a hard one to hold. But the large chart never lied, did it? The large chart always said down. The large chart always said momentum. And that's just that small crowd fighting amongst themselves. And eventually, large crowd wins and down it goes. What a beautiful hold. What a great read on the large chart, setting you up to be successful on the small chart. Really well done, Gerard. That's a difficult hold, and you absolutely crushed it. So good job. And then Morgan, large chart says up from the termination. And then the 50-50 is more likely to hold. And you take the perfect entry. And we know that one went up, right, Morgan? Termination reverses the market, increases the likelihood of success. 3 divergences confirms the termination. You don't get caught in the sideways, right? Right off of fib, not a clear path. It's ugly, split triggers. And then eventually it all comes together. And this is one of the best lessons. And Muser, you're going to get credit for this till the day I die. When you don't try to force or fabricate, the right trades show up. When you don't try to make something happen, things happen, guys. And Morgan, that is the perfect read. Absolutely beautiful. Those are the easy ones, man. And then Paul W. says, well, it's so easy. I can do it too. Close, take your choice. I like it. Not a good bottom. No fibs there. None whatsoever. Great patience, though, Paul. Absolutely great patience. Waiting for all the nonsense to stop, and then it gave you the easy winner. And probably not even a reason to get out there, but I don't think I'd be bummed about it. You made great money on that one. Nice trade. And then this is one of the things that I want to point out to you guys. Hold on, let's see who's next here. That was Morgan. That was Paul. That was Morgan getting paid on the same trade. Absolutely love it. You held that one out at the one-to-ones, out at the fib. Beautiful trade. And then Malcolm, we fixed your charts, right? Andy, what do you have, my friend? Odds favorable momentum, clear path. Andy, why are you in? Oh, you're in at 23. So you took the same one, perfect entry. Your timestamps are weird though. That threw me off. But that's the exact same trade. Andy doing it perfect. You guys want to see something cool? And this is especially for you new guys that are trying to decide, do I want to do Nexgen? Do I want to be a part of this stuff? Or are they just kind of making stuff up? This trade, what was your entry? 22, 23, 22, 23. Isn't it pretty cool that three different people in three parts of the world are looking at the exact same market and taking the exact same entry, and every one of them is getting paid differently? Paul got out at 1-to-1s. Malcolm held for the fibs. Andy got out at the divergence high right near the 1-to-1s, and none of them are wrong. But everything that they did, guys, every step to success there came from the rules being met. Everything came from, man, we're going to figure out how to get your pictures bigger. Blew past the first fib, took a bet based on how fast we went through the first triggers and how... Oh, Morgan, I'm falling out of love with you right now. Took a bet. All right, I got to take two separate pictures. Took a bet. Bah. Bah, I say. How about this? I had a termination that created a full reversal. I had odds favorable momentum here, but it was directly into a fib, and I chose not to take it. And then once it began to clear, I took a pullback to support right inside of favorable large triggers on a 50-50 without divergence, and I made all the money. You didn't take a bet, my friend. You followed rules. You may not have known that you followed rules, but check this out. I love doing this. Whoops, let me close that. This is one of my favorite things to do with new users, and you're going to see why. I'm going to open up the KISS trading plan real quick, and let me make this a little bit smaller. And I'm going to snap a picture of the 50-50 rules. And I want you to see something pretty amazing. I think it's amazing. You may not think it's amazing. I still get pretty floored by this stuff every now and then. Did I have a good top or bottom? Yep. Did I have odds favorable momentum? Yep. Smalls outside of the large? Yep. No divergence? Yep. Get in at the area. Zoom. The cool thing is, Morgan, is you never have to feel like you're taking a bet. You never have to feel like you're hoping, that you're wishing, that you're wanting, that you're praying. All you have to do is follow rules that have been proven to win more than they lose, and that's exactly what you did, my friend. You waited midway through fibs to raise your stop loss and sold 1-to-1s, got rid of half at the first trouble, and sold the second contract at resistance. Absolutely amazing, Morgan. So what I would do is I would take this picture and I would go to my perfect looks, because you couldn't have done this any better. I couldn't have done this any better. I teach the class. Perfect 50-50, all rules met. Not a bet. Boom. Great trade, Morgan. Great annotations. And you know what I keep saying, this is what I love about this class. I think I love everything about this class. But you took the time to write what you were thinking. You took the time to write what you saw. You took the time to say, this is what I saw, this is what was going on. And I don't disagree with any of it. But what we were able to do is say what you saw, let's say it like rules, right? Let's say it like rules so that it's repeatable. Let's say it like rules so that we can do the same thing over and over again. Freaking amazing. You guys make me proud. Andy Man. No, 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 no. Same trade, right? No, different look. Momentum. Where's your momentum? I don't see momentum. You're in at 74. Andy, this is the one you thought I was going to get you on the momentum trade, right? Or on the momentum? Cool. Andy. So this is a strong trending market. And that's all it is. This is a strong trending market. 30 plus bars, broken areas, no reversal bars, large chart. All this is, guys, is a strong trending market. Andy recognizes that. Everything says up, and it's been going up for a while, right? Andy, is that fair to say? I don't want to put words in your mouth. When I have a strong trending market, when I have the smalls riding the large, when everything says up, when my path is clear, there is a school of thought, Andy, that says buy that damn mid-band until it stops working. Buy that mid-band until you hit an area. Buy that mid-band until the market gives you a reversal bar and the triggers roll. Does that make sense? All you did is you took a market where everything set up, everything said it wasn't going to stop, and even though this isn't the perfect entry, you're just like, you know what? Until that stops working, that's my entry. And it's just taking advantage of a strong trending market. So outstanding work on this one. I'm not even going to beat you up on the momentum. Because I think you're associating that strong run up with momentum, and I don't disagree with you. When you have a strong trending market, you can say the momentum is up. Is it odds favorable momentum? Is it strong triggers? Hell no. But everything says giddy up, Andy, and you capitalized beautiful, and you weren't greedy. You got out of trouble. So rock star status for you, my friend. Well done. And then Jonathan, oh, we saw that one. Here we go. Got some annotations. Entry where? Into all the fibs, Jonathan? This is where arrows are going to pay dividends too. Met your daily goal with 2 small trades. That's how we do it. So, Andy, are you saying that you don't need to be in home runs every time? You just wait for all the advantages, hop in, get paid, get the hell out, go do something fun with your life? That sounds like a great way to live. Nicely done, man. It's been fun watching you find your groove. It really has. Jonathan, you're wondering about this mid-band, right? Mark, it's the gap theory. You even called it. Should I be going long? Is that right, Jonathan? Are you in here still? So what happens is this is aggressive, right? Because the momentum is down, the trend is down. We're coming off the areas. This is a very aggressive trade. It gets easier as it works up, and unfortunately for the brand new user, this is just a nothing to do. This is the don't take the short trade. And you recognize the gap theory, perfect. Mid-band, large triggers, a full bar away. This is where, Jonathan, I start looking for opportunities somewhere over here. And it doesn't look like it presented any until right there, right at the mid-band, right inside of favorable large triggers. And this is very much, unfortunately, one of those not my money as a brand new user. And I like that you're recognizing, I like that you're talking, but instead of asking entry, one of the things that you can do is you can say, were my rules met? right? So write your rules on the chart. Write down, did I have odds favorable momentum? Not for a long. Did I have a clear path? I didn't. And it's okay saying it isn't my entry yet. It isn't my entry yet, but Jonathan, it's a great recognition of that gap theory. It's an often opportunity to go back and look on the small chart. What happened when that gap theory came into play? Was there a potential entry based off of that? And then, can you tell me why this would be no entry based on triggers? This would be my next question because, again, and let's do what we did to Morgan. Let's put you on the spot the way we did him. The trigger's above where? I'm not sure which one. So here's a termination. Let me go through my little spiel and help me out. The midband's a termination, and it creates a reversal, so I have a good bottom. I have odds favorable. The one thing I don't have is the smalls outside of the large, but I have no divergence. And I do have an area right inside of those triggers for the entry. I love this entry. Is it this right here that you're wondering about? The small triggers turned against you? I just want to make sure that I'm doing this right. Okay, so the small triggers turning against you. Thanks, Andy. Let me show you something cool. I'm going to go back to just straight out of the user guide on this one, because I had to learn this lesson as well. And we'll take this picture. And this is just a high probability trend trade entry. And then I'm going to couple it with this picture, or at least that little piece of the picture. So when we start, Jonathan, when you started looking for this trade, the large chart gave you your direction, the large chart gave you the momentum, and the large chart told you which areas may be problematic, right? The large chart gets a lot of work done for us, guys. Rules 1 and 2 are met on the large chart, and I just messed that up. So let me take a picture of your picture again, sorry. I thought that I had that on there. So the large chart told me that I had momentum, a clear path. Everything was up on the large chart. Life was good. Things were aggressively going to the upside. And remember that inside of that one bar, Jonathan, that told you that you really wanted to be looking for a trade, the top of that bar was the beginning of this pullback. The bottom of that bar was the bottom of this trade. And then the next bar didn't start till all the way over here. So what we're looking at is this dissection on a smaller, faster chart. We're looking at a dissection from one bar on the large chart. Things that happen on a small chart. More often than not, your small triggers are going to roll against you because remember, it's a tiny little entry chart and it has to lose a little bit of momentum to push back. Does that make sense? This is pretty common for new users. New users go, oh my gosh, my momentum's gone. So great recognition of a little momentum loss, but on a small chart, this doesn't scare me because this very much is the reason that I'm able to get back to my best of the best entry area. Does that make sense, everybody? That's pretty common for new users. It's easy to let red triggers scare you out of a loan. I hate that answer. That's okay, though. Inside of that one bar, we're going to see fluctuations on a small chart. And this is another thing. I see a lot of new users jump in on a little push up. And the same is true. I see them jump out on a little push down. Large chart leads the way. Large chart has momentum, areas, direction, everything. These little fluctuations are going to happen, guys, which is why we spend so much time focused on using the small chart as an entry chart. There's one thing that'll keep me out of a trade on a small chart. There's only one thing. that will keep me out of a trade on the small chart. And some of you remember it's 3 divergences in the same price range. So I want you to see this. On this perfect pullback, it bounced off of a fib. On this perfect pullback, the smalls turned against it, right? It's okay because the large chart said down. The large chart said down with strength. And if you go through and you really want to develop a little trust in this, start going through these client trades. And I'm going to click on one that says high probability trend trade long. Maybe. And the small triggers turn against me. And I'm going to high probability trend trade short, and the small triggers turned against me. So what I can do is I can start saying, wait a minute, let me look at these pictures. Let me look at a few longs and a few shorts, and let me see if those small triggers turn against it. Let me see if 2 divergences kill it. And what happens is Jonathan, you'll never let those small triggers scare you out of a trade again. And that's exactly what I had to do, is I had to go back and do that a couple times in order to build that faith in the idea that it's okay. And then you're still everything up, everything's strong, and you still had an area inside of triggers, and it's on its way up. And you could reduce your risk behind the reversal bar already. And I'd love to see how that one turned out for you. What did you do, Kenan? I don't know what that is. But everything is down in a strong trending market. You let the area clear, take a little snap back, and get paid on the way down. Nice job, Kenan. I love the trade. I've never seen that before. I wonder if we could find it. Is there a trend button? I don't know. I don't know what that was, Kenan, but I like your trade. I like that you let the area close and then you traded from the area instead of trading into the area. And that is one of the easiest ways to have dividends paid. This is a strong trending market. Everything says down. This thing's cranking through. And you said, you know what? Let me let it clear and I'll sell a little snapback. Absolutely beautiful trade. I don't know what the trend thing is, though. I've never seen that. And then Paul asks in the room, Mark, getting in on a reversal bar that does not have a stab back to pick up the trade requires a limit order below the reversal or a stop limit order. What's the difference between a limit order and a stop limit order? And I don't know why I wanted to go, hey, first time caller, long time listener. You think it's for playback? I don't think so. Playback looks like an old Sony Walkman. You guys want to see something cool? What is the trend tool in Ninja Trader 8? Oh, trend lines. Identify trends with
Ninja Trader is equipped with over 100 free pre-built indicators to aid in your technical analysis of the markets. Indicators can be applied to Ninja Trader charts, the super...
Maybe, I don't know, Morgan. All right, Paul. Paul says, what's the difference between a limit order and a stop order? Buy or sell stop. Paul, are you with me? If I want to go short, when price returns to 52, I right click and I put sell limit to, right? So if price comes up to 52, that is on the other side of price. It's above price. It has to pull back, hit me, and then I enter. If I say, if I want to enter the market, if it comes down to divergence, I can sell stop. So what this says is, this is how you can get your entry on the trade side of price. By having a sell stop here, if the market trades down and hits my sell stop, it'll put me into the market. So the way I would use this, Paul, is if for some reason this reversal bar, if this creates a reversal bar, it's going to put me in a long position. I'm going to right click and I'm going to put a buy stop right on my reversal bar marker. And what I'm saying is I need confirmation for the long. Obviously I don't. It's odds favorable momentum to the downside. But it's saying the only way I will ever take a long is if I get a reversal bar in the direction of the trade. So if I get a reversal bar in the direction of the trade, it's going to put me in that long position. So if I'm looking for confirmation, then I'm good. Does that make sense, Paul? No worries, Malcolm. Take your time. I took the candles off. Connected to simulated data feed because the ability to control market data is generated on your account. The trend slider lets you control which was generated. Oh, wow. That's kind of cool. Thanks for that. Limit orders do, Rob. So limit orders do. If I want to go short, my limit order will be above price. Does that make sense, Rob? That means the market has to come up to me, and then I expect it to go down. If I click below, a limit order will be below price. If price pulls back down, it'll put me in. A stop order says, if this turns into a reversal bar, and we'll see if it'll happen, but if that turns into a reversal bar, it'll put me in the market. So buy limits go above the market or below the market. Sell limits go above the market. Limits and stops are two different things. A sell limit would go up here. So if it retraces up here, it'll put me in a short position. If it gives me a reversal bar, it'll put me in a short position. Two different entries on approach. One says the market has to go up to it. The other one says the market has to go down to it. So Paul, if the requirement is a pullback, you're going to use a limit order. If the requirement is a reversal bar, you can use that stop order right on the reversal bar market. Order canceled. Just two different ways to skin the same cat. Does that make sense? I hope. And guys, go play with these. Go play with stop orders, limit orders. Do it on simulator. Have fun. Question mark. I see what you did there. Do I ever look left, i.e. yellow 1-to-1s for a termination here? Or do you only look at the blue line termination condition here? What chart is this? 13.2? Oh, so Jen, are you asking me, even though this stopped printing, do I create a line in my head and respect it for the rest of my life? Oh my gosh, that would be exhausting, wouldn't it? Can you imagine having to keep looking back over and over and just wondering if you're supposed to care about that? Yeah, stop. Life's too short. When this thing stops printing, it's gone. When this divergence high stops printing, it's out of play, right? When this fib stops printing, it's out of play. So live in the moment, Jen. You guys broke up. It's over. Yeah, you still see him here and there, right? But he doesn't affect what's going on now. Great question. It really is. That's a great question. All right, Pinieski. Momentum. Two divergences on a 50-50. I love this. Guys, you want to talk about learning patterns? And Pinieski, I don't know if you're in here. Momentum trades are just that, guys. Momentum trades are trying to capitalize on momentum. That's all it is. Divergence is a loss of momentum. Paul is in and out almost instantly on this trade. Most failed momentum trades turn into a trend trade. He gets back in and gets paid and protects himself because it's a 50-50. Paul, that's some heads up trading. And then Jonathan, we saw that one. 5 divergences, however big, still good. I see 2 divergences here. I've got 2 above and 1 below. Large chart still says up. If I get a third divergence right there, that's an exit condition for me, Jonathan. So right now there's only 2, and there's the potential of 1 more. I'm not sure where the other ones are that you see. See 1 there, but that's helping you, and I see 2 against you. So let's go to the ES real quick and see what happened with that. Third divergence printed right there, and look at how far back it pushed you. 3 divergences in the same price range pushed you all the way back to Fibonacci support. It's just rules, guys. Don't let it be more than it is. Don't add to it. Don't create different scenarios. Just enjoy the idea that you've got a set of rules that work. Termination, 50-50, no divergence, perfect entry. I love it. JW fits the rules 100%. Termination reverses the market, gives you odds favorable momentum, potential to break, perfect entry, and you're looking for quick profits. And divergence can kill a 50-50. It should have killed you, but you held on to it anyway, and you were able to get paid. That's a tough one. That's a tough hold. That's a lot of faith. But it's still in that window of opportunity. And it's still strong triggers. Man, there's more to this than just the basics, right? Termination reverses the market, guys. That's always a great way. 50-50 with odds favorable. Notice that JW still has strong triggers with the divergence. JW's been doing this long enough to say, man, I would just get into the midband anyway, and my stop would have to go up here anyway. Let me just hold it. And then out at trouble. He held his mud. It's a great trade, guys. If you don't see these patterns enough, that one will scare the ever-loving crud out of you. All right, who was this? This was Malcolm, I believe. Malcolm, are you back? Has it been 3 minutes? Okay, cool. Good top? Absolutely. Strong triggers? You better believe it. Clear path? Without question. Oh, it's those darn split triggers, right? Do you recognize the split triggers, Malcolm? This is the only lesson I want you to get out of this. Is when the triggers are split, it's okay to wait for confirmation. And it looks like that's what you did. It looks like it came up and you said, I thought it was going to be there, but now it's going, let me jump in, right? Which means that it could still, as long as it's dancing in between, and that's confirmation, and that's confirmation, and you just took the first one, and you held beautifully because you still had the correction points, and you took it all the way down. And this is outstanding, letting the large chart lead the way. And this is very similar to what JW did. When the large chart says go, 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 the momentum is the best, the path is clear, and everything's great, you may have to suffer some fluctuations. And you did it like an absolute champ there. Nicely done. Does that make sense? You didn't let the small chart scare you out. Everything's still set down. That's like some veteran stuff there. Beautiful. You know what's cool? That is all the pictures, guys. You guys made it. Yay. What's the live market doing? Dancing around. Everything says up. Everything says up. 3 divergences says the market may reverse. It didn't, but it pushed all the way back to support. And when I reached support, all of my triggers were above. And this support was likely to hold, and maybe you waited for confirmation and got back into your trade. Maybe you didn't. And losing momentum. No areas. Well, I guess there was a mid band or yellow 1-to-1s. But hell, you didn't even get a reversal bar before they got hit. Do you guys see how your areas fall beyond the correction point? Such a good lesson there. On your simulator, you have no limit trade. Are you sure, Jonathan? If you right click, it doesn't give you sell limit. You have to right click on the chart. There's not a button up here. You have to actually right click on the chart. You should see sell limit to. Double check that for me real quick. They're not going to be up here in the buttons. Just right click below price. It should give you a chance to buy limit to. Up here, all you can do is you can buy market or you can sell market, and it'll put you in instantly. But you have to actually click on the chart. You have to actually right click and do that buy or sell limit. All right, guys. Look at that. Resistance. All the triggers are below. Not quite gap theory, though. Guys, I'm going to take about 2 minutes. I'm going to come back. When I come back, we are going to... really, it's going to be your class. You guys are going to tell me what we're going to talk about. It is there? Awesome, Jonathan. Cool. And man, I'm telling you guys, there's absolutely nothing that we can't fix together. All you got to do is ask. So give me about 2 minutes. I'll come back and we'll finish strong. I've got about 30 minutes left. You have to be there at noon? Jane said? Okay. Okay. Well, then I'll slow roll out of class. I won't be late. Okay. No worries. Just want to make sure. I got like 30 minutes. Yeah? Zane 0916. Sure, whatever you want. Hi, Miss Ellie. All right, guys, we're back. So we got about 20 minutes to be brilliant, right? What should we do? What should we talk about? Let me talk about something that happens a lot. And then you guys, just if you can have this in your brain. One of the things that happens a lot is you begin to read the software, you start getting good at becoming a chart reader, you really getting focused on these patterns. As people get tempted to begin to trade their chart reads rather than trading their actual rules. Man, I know that this is resistance and it has the chance to hold. I'm going to go short when I get close. And what happens is you first break the short rules by not being inside of triggers, and then you see a reversal bar and you hope that it's going to go from the wrong side of everything, and then you trade Fibonacci resistance and you get stopped out, and you form all of these opinions because your chart read says that the market should continue down, and it's a great chart read, but you've got to let your chart read take you to your rules rather than your chart read dictating that you're going to enter based on the reads. And this is one of the biggest things that I see, well, that I saw in myself, and I see with new users. So I wrote this, and this is kind of cool. Maybe, maybe not. I don't know. Um, Actually, it is, because I say it is. Your ability to read your indicators, ladies and gentlemen, your ability to read your indicators, your chart reading is going to let you know if your rules are met. The read confirms the rules. So I want you guys to embrace this a little bit, because the smarter you get, anybody see Full Metal Jacket when they're running through the mud puddle and they're like, we are beyond the drill instructor's reach now. We have autonomy. You're going to get to that point. So it's important that you let your reads carry you back to rules. If you read strong triggers on the large chart, well, then rule number one is met, right? It doesn't mean a short, it means rule number one is met. And if you read no termination conditions, then rule two. And if you read that there's an area inside of favorable large triggers on your small chart, then rule number three is met. And then once your read confirms the three rules for the high probability trend trade, you have a trade. And that's like the most basic form. And then it's going to take you on to bigger and better things with the read. So like if the market is not coming from a good top or bottom, this is your read. You start incorporating these concepts from class. Then your ability to recognize that pattern, to read that pattern, has you thinking that the mid-band may be the first spot for a potential bounce. So you can create an expectation based on the read, but it doesn't mean that you're arbitrarily entering the market, that you're embracing that read as gospel truth, right? Your read is that an area may stop the market, and it doesn't mean that you automatically just go the other direction. You have to wait for your rules to carry you that direction. So that's one of the things that I think is worth sharing for the new user, is focus on your reads, focus on that statistical advantage, and your reads will tell you if the rules are met. I'm just going to ramble, guys. I'm going to ramble for 20 minutes. Just be warned. The next thing I'm going to tell you is that you're going to hit a spot. So right now, Morgan, Malcolm, Jonathan, you guys that are brand new, is you're embracing this spread, this checklist, right? You're embracing this KISS plan. You're like, man, it can be easy, it can be focused, it can be streamlined, it can be high probability. I'm going to follow this to the letter. I'm going to take these trades that the rules say take. I'm going to focus and I'm not going to deviate because I am the best of the best. Which chart? What market? Kenan? Am I boring you? Is that what's going on? That's okay. We'll do whatever you want. Oh, and of course, my live chart just heard that you wanted to see it and crashed. Give me 1 second. What market do you want to look at, Kenan? And we will, absolutely. While that market comes back up, let me go through this, guys. There's this crazy phenomenon called crude oil. Okay, it's coming up. Give it about 30 seconds. That used to be a phenomenon with when I taught managers. I know you're not. I was just playing. When I used to teach managers in a different industry, is I used to give them checklists to be successful the same way I give to you. And right around 30 days, everybody becomes smarter than the checklist. And that's when challenges present themselves. So as you start getting comfortable, remember that it's typically, we're loading up right now. It's typically the checklist, the rules adherence that is bringing you that confidence. Don't lose that adherence to rules when you start getting good. It's all good information. So let's analyze a large chart. My trend appears to be up. My small triggers are down and my large triggers are down, but my trend is green. So I don't have any advantage of momentum. I had a mid band floating inside of large triggers, and the market's continuing down. So, Kenna, we're going to turn this into kind of a big read here, okay? Okay. That's exactly how it should look to the new user. I'm going to show you something kind of cool, though. So this is where we talk about the chart read. Do you remember that if we have a bad bottom, if it's not from an area inside a favorable, or if it's not from an area, if price didn't reach the fib, one-to-ones, divergence highs and lows, this is what we call a bad bottom. Is everybody good with that? And if it comes from a termination, it's more likely to carry. So I'm going to show you guys a pretty common pattern. When I have a bad bottom, my expectation is the mid-band or any resistance around it, right? I'm not trading into this. There's no freaking way. There's this concept or this idea, this pattern that repeats itself of unfinished business. And what that means is that the sellers tried as hard as they could, and they were cranking it down, guys. And then right about there, the buyer said, you know what, we're going to push against you. We're going to see just how committed you are, but the sellers are looking for these fibs. And I'm telling you right now, guys, if you don't believe that whoever's in control is trying to hit that fib, you're going to create a lot of opinions. So what happens, Kenan, is from this bad bottom, I know that I'm not going long, right? And I know that I'm not going into that area of resistance, but I can begin to create this expectation that they may finish the move down here to 21. So what I do is I don't arbitrarily jump in at resistance against triggers, against direction, against all of that stuff, right? But when everything kind of rolls, my large chart isn't perfect, but my small chart's saying, hey, you have a shot off of a mid-band inside of triggers. If your chart read, the expectation that it may finish the business is in place, this may be a low risk entry to try and take advantage of it. And so far, it's working out. So the live market doesn't say short for the new user. The live market doesn't say momentum for the new user. The large market or the live market doesn't even say favorable large triggers for the new user. But for the chart reader, is there anybody that's in a short position right now? For the chart reader, let's go through and chart read it. Price reaches resistance. All of my triggers are a mile below. This is an area that's likely to stop the market. When this area stops the market, I may take a pullback. Doesn't have to be, Paul. You can break your rules all you want. That's the beauty of it, guys, is I will never have your software turned off if you break your rules. I won't have to. You're going to go back to selling socks at the Quickie Mart. So the chart read creates the expectation, Ken, and this is a great example. And then based on your expectation, you may be able to find an entry that makes sense to you. You may be able to find an entry that gives you the opportunity to capitalize on the expectation. Is it a high probability trend trade? Hell no. Morgan, we have cameras everywhere. Everywhere. But like that's that bad top, straight to the mid band, off it goes, right? We did this earlier too. Bad tops and bottoms. Well, there's a lot of great fibs holding, guys. This software is amazing. But This usually suggests that the fight's not over. But let's go back to advantages again. Let's just keep capitalizing on this one look. Kenan, do you have momentum on the large chart? Not so much, right? It froze, Jonathan? My first suggestion is to always make sure that you don't have an F or an arrow. Because sometimes when it freezes, we accidentally bump it out of play. And it looks like it's frozen, but if you have an arrow, click it. If you have an F, click it, and it should bring you back to the most common bar. If you don't see that black highlighted price, then I would shut it down. And what you may need to do, Jonathan, is hold down Control, Alt, and Delete at the same time. And if you do that, it'll give you the option for the task manager, and the task manager will let you highlight it and end the task and kill it. Sometimes, Paul. There's nothing freestyle about it. So we speak to ourselves in terms of advantages. So I don't have momentum. I do have a clear path, and I did have an entry area. What does this mean? All this means, Kenan, is that I have 2/3 of my advantages. I have an expectation based on a chart read, not a gospel truth, just a pattern. Am I willing to take a shot, hoping the market fulfills the expectation of the pattern? Does that make sense to everybody? So if we take this and we go back, right, we don't have momentum. We had a potential entry and we have a clear path. Am I willing to take this trade? And the thing is if you are one of the gifted that follow their rules, if you are one of the disciplined that follow their rules and only take trades that fit their rules, then here's what you have to do, Kenan. Because I haven't reached an area. What defines a clear path? No, not okay. Guys, when you tell me okay, it really means that you just want me to shut up usually. So no termination conditions means that we have a clear path, right, Kenan? So in its most basic form, that's what defines a clear path. And in order to define a termination condition, price must reach an area. Are you comfortable with that same lesson I give every day? In order for it to be a termination condition, price must reach it. So if I'm hovering in between lines, I really have a clear path either direction. That's why it's a clear path. Does that make sense? Awesome. And then look at this. Look at that picture, the chart read. Expectation fulfilled. Hey guys, this is why you have to have faith in these fibs. This is why you have to believe wholeheartedly that you know where the market's likely to go. That's your chart read. You have to believe that these fibs are capable of not only stopping the market, but attracting the people in charge to get to them. And once you do that, once you start to get these little faiths in there, Kenan, I love everything about the short right here. Wild horses couldn't keep me out of it. I would be willing to lose $100 on that trade, because I've seen this pattern repeat itself over and over and over. And Jonathan had an amazing picture earlier. Let me see if I can find it. So check this out. What do you think, Kenan? Bad top, right? Triggers break through the areas, not a strong top. It pushes all the way to the midband, and the gap theory is in play. So I'm not going short. I can begin to create an expectation that from this bad top, they might be looking for a fib up here. So when it begins to spin and I get on the right side of everything, maybe I find a little momentum trade right there at those 1-to-1s, right there at those, at those small triggers going up. The large chart read creates expectations. I'm just going to look for a way to capitalize on it on the small chart. So if this trade isn't in your trading plan yet, Kenan, your job is to go back and find 50 pictures that support the idea that this is a trade that you should take, right? You have to ask yourself, does it win more than it loses? What's it look like? What's the best way to take it? Do I take it as a pullback like an ugly trend trade? Do I take it as a momentum style trade where it just snaps back to the small triggers right at an area? How do I manage it? So you begin to build this plan, but everything stems from your ability to recognize this pattern. And that kind of goes back to the whole idea, let's become chart readers and then let's let that turn us into day traders. That was one of the greatest questions ever. Thank you for asking me to analyze that, because we got to talk about a lot of different concepts. But did you see how I stemmed it all back? I love these because these are fun, guys. I fought this forever. I just wanted to find trades. I had to ask myself, do I have momentum? Do I have a clear path? And I want you to see how that one understanding of what creates a clear path pays dividends. So if price reaches an area, triggers are below, that's a termination condition, right? That says no long trades. So you don't get suckered into the long. You don't say, oh man, look, it reversed. Here we go. We're going long. You say, that's not a long trade. And then you start saying things like, man, my large triggers didn't even bend. My small triggers have already turned back down with the large. Everything about this chart except the color says that it was a termination that's pushing down, and all my triggers agree. I wonder if I can find an opportunity. And you will. And then you'll start writing rules to help you capitalize on this opportunity. And now we're into a termination condition. And I'm saying to myself, no more short trades, right? And I start playing this if-then. If support breaks, I'll look for odds favorable momentum and a pullback. If support holds, I'll look for a reversal, and I'll try to capitalize the exact same way I did here off of this termination condition. So you really just start to add that next trade, and it just comes through repetition. It comes through seeing the same thing over and over again. Thank you for that. Anything else, guys? This is a good class today. I feel like we got some work done.